Be 450 and people will just say, yeah, it's a random number.
You really want this weekend, don't you? Hey? Up next on the programme, Priya Misra of JP Morgan, Terry Haynes of Pangea Policy, Alan Zettner of Morgan Stanley, Jane Foley of Rabobank, the second hour of Bloomberg Surveillance is up next. Lisa might go home. I've got no idea. She might stay. The jobs report, a few hours away.
Am I wrong?
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
I think the most important is the labor market.
I think some of the data has been overstating the health of the job market.
We're going to see more challenges to labor supply.
We would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are in fact sustained.
Going forward, I do think that you'll see a payroll impact estimate from slowing immigration. But it'll be kind of harder to figure out how that happens to actual unemployment.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Do you remember the trade war? That was Monday. It's this week. Feels like months and months ago. What a week it's been. We're 90 minutes away from the payrolls report. It's just around the corner. The focus shifting to the economic data in America. The estimate in our survey, at the moment, the estimate's 175. The high is 240. The low is 105. So far, looking at the data this week, a bit of heat coming out of the American story. The economy just a little bit softer than maybe some expected. I say a little bit because jobless claims are still in the low 200s. Job openings are still somewhat elevated. The ISM's still pretty decent in expansionary territory. But this is not the fear that some carried into 2025 about an economy getting away from us and a Federal Reserve that might need to hike.
That ship seems to have sailed. A lot of the pro-growth policies that we have yet to see so far have kind of moved to the back foot, and people are focused more on the idea of maybe slower growth from a lack of certainty and potential tariffs, which is the reason why the best interview of the morning is coming up with someone who says that a weaker report will have a bigger impact than a stronger report, and that really sets up the framing of today's labor market report.
It's nice to see you get back to shifting towards promoting programming again, and what an important morning this morning is. The most important jobs report since the last one until the next one. You know how this works.
You're crushing it.
Right? In the bond market, big week for Bramo. That's why she's so tired. The 10-year yield at the moment, 443. The Treasury Secretary coming out and saying they're very focused on 10-year yields. And then the following day, we hear a tax plan that includes a long, long list of tax cuts and very few offsets, even though we got a surprise.
We got a surprise when it came to carried interest loophole. Trump apparently wants to close that now. People I'm talking to say, please don't read too much into this. They do not think it's happening. I think what's more interesting last night is I would say I started the week, especially when I caught up with Jason Smith, chairman of Ways and Means, I started the week thinking the House was going to get railroaded. This weekend by the Senate. Trump went into the evening with some of these Congress members, and today, potentially, we will get their bill coming out, or theories of what this bill is going to be, what's going to be in it, coming out today. And maybe he wants to go back to this one big, beautiful bill, which means a lot of tax cuts, which means a big deficit.
The takeaway for me is this is going to be messy. This is messier than a whole bunch of executive orders that talk about tariffs. And that messiness is what a lot of people in markets are putting into their models of maybe that pro-growth impetus isn't necessarily going to come as quickly as many people thought.
So we started this week talking about trade, and we close out this week talking about tax cuts. And what I really want to know is how one complements the other. And hopefully when we catch up with Kevin Hassett, the National Economic Council Director, later on this morning at around 9 a.m., we can get some answers to that question. Because around the objectives around the trade war, and I think we've got to go back to Monday, what are the ultimate objectives here? Is it a drug war and not a trade war? Is it about getting concessions on the southern border? We've had one already. Is it about reciprocity? I'm thinking about China, I'm thinking about Europe. Is it about deficits, or is it about paying for these tax cuts? There's a lot of questions there.
I think when it comes to Donald Trump and the fact that he is transactional, when he looks at tariffs, it's a bit of everything. Kevin Hassett himself called it a drug war when it comes to Canada and Mexico. But potentially, with all of these tariffs, they continuously talk about these could be incredible revenue raisers, and to offset. Potentially, that means you're going to have to get the tariffs first to then offset the tax cuts and the longer list of tax cuts we got last night.
The jobs report, 8:30 Eastern Time, 1 hour and 26 minutes away. Equity futures at the moment, totally unchanged. This market's going nowhere. Coming up on this program, Priya Misra of JP Morgan on the Fed's balancing gag, Terry Haynes of Pangea Policy as Republicans look to strike a deal on Trump's agenda, and we'll catch up with Alan Zedder of Morgan Stanley later on this hour with payrolls on deck. We begin this hour with stocks steady, ahead of payrolls data due at 8:30 Eastern. Priya Misra of JP Morgan Asset Management writing this: valuations imply that the rate reaction into payrolls is asymmetric. A weaker payrolls report will have a bigger impact than a stronger report. Priya joins us now for more. Priya, it's good to see you.
Likewise.
Why is that the case when yields have already drifted lower by some 40 basis points in the last few weeks?
So I think you're right. Rates have fallen. I think if you look at why we got to that 4.8% on the 10-year, it was actually driven by this fear that the Fed might have made a policy mistake. Maybe we were re-accelerating. I think that's been taken off. Inflation does seem to be, look at 3-month moving average of core PCE. It's 2.3, very close to that Fed target. So I think the Fed message has been, we've recalibrated. The first 100 basis points is done. And after this, we're going to just have to, wait for more certainty. I think the other part is the market got a little ahead of itself in terms of fiscal. It was always going to be about sequencing. We got trade. And I think trade is creating all this policy uncertainty. Fiscal is going to be messy. I like your word on it. We're going to spend all year talking about fiscal because there's just so much and there's so many stakeholders. So I think some of that move from 4 to 4.8 was that. The reason I think is there's an underlying fundamental assumption of U.S. exceptionalism, the fact that the soft landing is solid, that the economy is strong. You start to see, and it's all the underpinning is the jobs market. If that starts to crack, and we've seen, it's a narrow job growth. If you see, and we're looking for the soft landing to continue, but what I do watch for is and today is going to be also messy because we're going to get the benchmark revisions, we're going to look at wages. Let's look at the totality of data. Hiring has been slowing, but if it is slowing to a sort of worrying level, that's when I think those rates are going to start to price. And we're pricing in 1.5 cuts this year from the Fed, which in an on-hold, you should always price in some chance of a further cut because the Fed thinks their policy is restrictive. So the Fed's telling you their reaction's asymmetric. I think 4.4, 4.5 is not that high on the 10-year. So that's why I think if you get a weak report, which we're not looking for, but if you get 100,000, and actually we don't even know what is weak because of labor supply, 100,000 used to be normal. I would argue 100,000 is weak now. If you get something like that, I think the market's going to price in more cuts, and we're going to start to question how strong is the U.S. economy.
That's exactly where I wanted to go, to pull out Pharaoh's random number generator and say, okay, what could cracks look like in this number, and how big could the response be? Would we get, say, a huge rally into the long end of the yield curve, but not a commensurate risk-on type rally in stocks and even credit?
I think it depends on where that weakness is coming from. If it's coming from a broad-based deceleration in labor market, I mean, it is just one report, so you may not get such a big reaction in any market. But I think if we have policy uncertainty, particularly on trade, that's negative for growth. And if you start to see that maybe it's a weakening of the labor market, so I think we look at the sectors, where is the weakness coming from? Are we seeing I would say layoffs are still low. So you may not get a very big reaction today. We're going to be watching, but I do think that the curve is likely to flatten. And the reason for that is we don't know what the Fed strike price is, meaning, at what point does the Fed start talking about rate cuts? They're not going to respond to one number. So I think it's the 5-year and out part of the Treasury curve that's going to say, well, the economy is not that strong, we're getting this policy shock or set of shocks, well, then maybe the Fed can't hike that much, but they're going to stay on hold, they're going to need more data. So I think risk assets might struggle a little bit with a weak number because I don't think the Fed comes out and says, oh, let's start to cut rates. They're going to say, let's take a step back. We're still above target on inflation. So I think a weak number today is actually weak for risk assets and good for treasuries. We've seen that stock-bond correlation. It's come back. I think as inflation fears have receded, I think rates will do, or treasuries will do well. Everything else might struggle on a weak report.
I want to pick up on that in just a minute. I do want to talk about the totality of data and the revisions and how you look at something that could potentially take heat out of the story of 2024, but doesn't tell us that much necessarily about 2025. How does that factor into your equation?
I think it's important to have that fundamental view of the economy. So to that extent, we will be looking at that totality of data. But the market's forward-looking, the market's pricing in. Now we're talking tax. And I know you all have talked about sequencing. I think it's fascinating that in the sequencing of tax, what we got earlier this week was talk about the 10-year, which I think is great because we've argued, and I think I've said this before, there's a political constraint in terms of how much they can get done on policy. I know you all have talked about it. There's a market constraint. What we got from the president, from the Treasury Secretary yesterday, they acknowledged that market constraint. So I think as we go into the tax discussion, different from 2017, where it was all about how do we get tax cuts, this is going to pay for itself. We're not hearing that now. We're hearing, well, let's look at the 10-year, which is not something the Fed can really influence. We just saw it over the last 6 months. They cut 100 basis points, the 10-year went up 100 basis points. So fortunately, it's less about Fed and Fed independence. And I think it's telling us they're going to need offsets because they're worried that the 10-year does impact the economy, which, the economy is interest sensitive. We've debated this because the economy has been remarkably resilient. There were a lot of positives. There was a lot of fiscal, et cetera. I think that's important, that sequencing.
Well, this goes to what Chris Verone was saying. What is the pain threshold in the market for their policies? What do you think it is? What's your guiding light?
I would say 5%. If you ask me for a number, gun to head, 5%. The speed matters, though. And so, there's nothing magical about 5%. I would look at 5%. I would look at real rates. I think real rates matter a lot more than nominal. This has been a real rate-driven move. That 4.8, we were starting to see risk assets starting to pay attention. So anything above 4.5 to 5, if it's driven by real rates, if it's driven by expectations of fiscal expansion, deficit financed, I think then it's tricky because I think this idea that tariffs will pay for trade, if tariffs are a negotiating tool, or that tariffs will pay for fiscal. If it's a negotiating tool, you can't have it both ways. You can't delay tariffs and then expect it to pay for it. So I think people will see that. And so I would say a quick rise in rates, getting to that 475.5, I think it's a problem for the economy and risk assets.
It's true. The rhetoric when he talks about tariffs is used for both. And I think it sometimes depends on the country he's aiming at.
Right.
But putting this together with the jobs report today, can policy coming out of Washington disrupt the soft landing you're looking for?
I have to think that policy uncertainty matters. I mean, maybe it doesn't matter for the consumer. I have a job, my real incomes are growing, I continue to spend. Companies, as they think about spending, CapEx, hiring plans, you know, I think if you don't know which certain sectors, I think we're going to see more dispersion, absolutely. Higher cost of capital, higher policy uncertainty. There's going to be dispersion in terms of winners and losers, which is why I think important to be diversified, important to do your credit work. But what I'm watching is what are companies saying in terms of CapEx and hiring plans? Is deregulation going to offset the trade uncertainty? We'll see. We just don't know. And so I have to think all this uncertainty has to be a growth headwind if it lasts for a long time.
Priya, it's good to see you. Priya Misra there of JP Morgan Asset Management. Lisa, just speaking to that, Bank of America put this out earlier this week. Our corporate sentiment indicator is still tracking at a record high. Mentions of better or stronger versus worse or weaker jumped to the highest levels since the fourth quarter of 2021. That gives you an idea of how rock solid corporate sentiment was coming into 2025. And what we discussed earlier this week, don't squander that. Don't squander that. We want to see that translate into actual action, hiring, CapEx, throughout the year and beyond. If there's uncertainty about the course for policy, these companies are going to hold back.
And right now, they still are in that sweet spot where if you resolve that in short order, they can potentially go back to that excitement. But we already heard that in some of the earnings calls. Ford, GM, even Amazon ratcheting back some of their expectations for earnings as a result, and frankly, what they plan to do. You don't want that to translate into the raw data.
You know what I was surprised? Front page of the FT today, deal making has suffered its worst January, worst start of the year in a decade. Remember when everyone was saying it can't get worse in the Biden administration, M&A is going to be on fire? Actually, it fell nearly 30% this January as opposed to since 2015, one of the worst in the decade.
I'd say give it a chance. The market's wide open. Financial conditions are still accommodative. If you want to make a deal happen, and antitrust you think is in your favor, I'd say just wait. It is still only February 7th right now, and only the third week of this administration.
If we're exhausted trying to keep track of it, imagine a corporate executive trying to
They've got these deals ready to go.
Great. Why would they go now?
Exactly.
Why would they decide to go at a time where it's unclear what kind of tariff situation they've got to price in and what kind of international risk they might be incurring?
Absolutely. The uncertainty, as Priya was talking about, the uncertainty might mean a cost. And not only that, maybe the tax codes are going to change. Do you potentially want to wait for some kind of deal to get a better deal if the tax code changes? That might be a 2026 story.
Equity futures right now, just about unchanged. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Japanese Prime Minister Shigeru Ishiba will meet President Trump today in Washington. As he left Tokyo, Ishiba told reporters he wants to build a relationship of trust and confirm cooperation over economic and security issues. During the campaign, Trump told Bloomberg he had concerns about Japan's trade surplus with the U.S. and yen weakness. And Pinterest shares are soaring in the pre-market, up 19% after it posted strong revenue and gave an upbeat sales forecast. The results signaled its advertising business continues to grow despite increased competition in the social networking space by giants like Meta. And the Buffalo Bills' playoff hopes may have ended prematurely, but they can officially claim to have the league's best player. Bills quarterback Josh Allen won league MVP, beating out Baltimore's Lamar Jackson in one of the closest races in recent years. It's Allen's first time receiving the award. That's your Bloomberg Brief. John?
Yahara, thank you. I'm sure they'd all swap that to play a game on Sunday night, that's for sure. Up next on the program, the president's fiscal priorities.
The best thing we can do for predictability is make the Tax Cuts and Jobs Act permanent. That would be the single best thing we could do for predictability.
That conversation coming up next. We'll catch up with Terry Haynes of Pangea.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The jobs report just around the corner. I'll repeat the number for you if you are just tuning in. The median estimate in our survey is 175. The number drops at 8:30, so 1 hour and about 12 minutes time. Equities going into it totally unchanged on the S&P 500. No drama so far this Friday morning. In the bond market, yields unchanged as well. The 10-year short of 450, very close to 440, 443.83. Under surveillance this morning, the president's fiscal priorities.
The best thing we can do for predictability is make the Tax Cuts and Jobs Act permanent. That would be the single best thing we could do for predictability. We can go back to the 100% expensing and add some new features that I think business is going to be very happy with. But again, the most important thing is that it filters down to working wages. The real priority is fixing this affordability crisis for the American people.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, making the case for passing President Trump's tax bill and making the 2017 tax cuts permanent. Terry Haynes of Pangaea writing, should the tax bill go to plan, it likely convinces markets to fuel U.S. economic exceptionalism for longer and with more fervour. Terry joins us now for more. Terry, welcome to the programme, buddy. It's good to see you, as always. We caught up with Kim Wallace of 22V Research about an hour ago, actually, who made the case that he'd be surprised to see a tax bill pass before December, and this might become a 2026 story. Are you on the same timeline?
No, not at all, John. And good morning to everybody. Not at all, because what they've got to do is they've got to pass this thing in the first calendar year. They know that. I've got the tax bill at 80% likely to happen. The reason why is you've got a Congress that knows it needs a signature accomplishment, and you've got a president that wants things. Look, what you'll hear from Washington tax boffins now is all process related and kind of third level stuff. But Bessent will give you the clue here. What they want to do is preserve United States economic exceptionalism in the markets, absolutely, for as long as possible. They need a tax bill for geopolitics to keep America strong. They need a strong economic policy to buoy the domestic economy and to make America strong abroad. All that stuff. And by the way, they've got to get rid of a world where debt service is the biggest expenditure. So because that imperils all of the stuff that I just mentioned. You've got a president that's interested in doing big things. This is a time for big things. This isn't a time for small ball.
So is this a time for one big bill or two? I'm sorry, this is the minutia of Washington, but I think it does matter because this is going to be incredibly hard, 1 or 2 bills, to make sure that this Republican Congress signs off on it, given, Terry, how slim their majority is.
Well, it matters some, Anne-Marie, sure. I'm not going to say to you the process doesn't matter at all. Of course it matters some. What I am suggesting, though, is that you shouldn't be diverted. No one should be diverted by process as if it's the main thing. And 1 bill, 2 bill, they get this thing done. You might recall back in 2017, Congress faffed around with doing health care for the first 4 months of the year, and then only switched relatively late into the tax bill. That's not going to happen this year. They're all about economy, economy, economy. But what I would suggest is that the answer to the process question is anything that helps achieve those big goals that I just mentioned is what the process is going to end up being. Beyond that, though, it's minimal. The people that are in favor of one big bill, by and large, are people who are afraid to cross Trump. But if what ends up happening is that 2 bills provide a quicker start to all this, then he's going to be for that too, and he said so.
Terry, the president has talked about a lot of policies, tax policies he would like to see. Yesterday, we got carried interest loophole added to the list, which took everyone by surprise. You and I both know that for decades, Washington has been trying to close this loophole, and they failed. Why is all of a sudden this a Trump policy?
Well, you know, I thought you all summarized this very well the other in the last hour. It's by and large political. It's certainly not a revenue raiser. I mean, there's one source that I've seen recently that estimated it raising something like $12 billion over 10 years. So, you know, it's a rounding error in the bigger picture. But you're absolutely right that it puts him on a kind of a populist political path. And if it doesn't happen in the end, well, it doesn't happen in the end. But that's not a frontline issue here.
In the meantime, we got the review from the Committee for a Responsible Federal Budget for the potential bill. It isn't great. It isn't great for that wonderful 10-year yield that Scott Bessent looks at. They said that it would boost interest costs by about $1.3 trillion over the next decade, exceeding $250 billion per year by 2035. Terry, how feasible is it that this Congress has the capacity to pass this bill and not just totally upend the bond market?
Well, here's a perfect example of what I mean by process, Lisa. Everybody's kind of focusing on the existing rules, assuming this is exactly like 2017. It's not at all like 2017, in part for the reason you mentioned. You know, there's a much less tolerance for extending debt and deficit than there was in 2017, and you had a relatively weak president and a relatively strong institutionalized Senate back in 2017. You know, the biggest debate that's happening right now isn't popping up in Washington conversations to markets very much at all, which is whether you'll use current policy as the baseline or current law as the baseline. Use current law as the baseline, then you're into what Maya McGinney's group talks about there. But if you change into current policy, then you become much freer to actually make the tax cuts a whole lot bigger and actually free up a lot more on what your pay-fors are and your spending are. I think I know which way this is going, and it's not going back with the small ball the way it used to be. It's going to the new baseline.
Which, Terry, raises the question of whether will it be allowed by this Congress. And some people point to the fact that you've actually seen quite a bit of unity when it comes to confirming some of the nominees, a surprising degree to some people. Do you think that that is just playing nice ahead of the hardball that's expected around the budget, or do you think this is setting a precedent for what's to come, that there will be that unity?
I think there's still going to be a good deal of unity, and I think the Senate particularly has done a very good job of defending itself against Trump demands. You'll remember back in November, Trump was blustering on about how he wanted his nominees confirmed immediately, and well, guess what? We're still confirming nominees. You know that a lot of this stuff is being done fairly quietly, but at root, people that are talking about maintaining the current institutional rules around the tax bill in particular are essentially saying that the Senate parliamentarian is going to be more powerful than the President of the United States and a majority of senators and the will of lots and lots of the American people and probably markets. So I think I got, unfortunately for the Senate parliamentarian, I think I'm taking the other side.
Terry, appreciate it. Well framed. Terry Haynes there of Pangea Policy. Did we settle that debate, 25 versus 26?
Well, Terry thinks it has to be done this year. He thinks it's going to happen this year. They have to have a win, and they know that next year is going to be very challenging. You have midterms then coming up. It has to be this year, which is why I think potentially you can maybe get one bill.
There also is this concern about the market. If you don't get some of the pro-growth measures, then how do you offset some of the other things that are coming down the pike?
Have to define the market, not your market. Bond market might be happy with that.
The bond market,
right?
Well, yeah, but happy. The rest of the world, yeah.
Sort of like
exactly
that kind of miserable happiness that the bond market has.
I just got another notice about an asteroid.
Lisa?
No. Helen Zettner of Morgan Stanley up next. That's brutal.
I know.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The jobs report is 60 minutes away. The median estimate in our survey is 175. Going into it, equity futures are totally unchanged on the S&P 500. And going nowhere. Likewise on the NASDAQ, likewise on the Russell. Let's get you some movers, your morning movers, with Yahara Hackers. Hey, Yahara.
Hi, John. I have 3 names for you moving here in the pre-market. We start with Skechers. Those shares are down some 12%, and that stock is taking a hit after earnings fell short of analyst estimates, and that was for 2 reasons. First, FX was a big headwind for the company, and on top of that, it's continuing to see weakness in China. So because of this and potentially tariffs, Skechers gave a cautious forecast that investors were not satisfied with. Next up, we have Expedia. It's a different story there. Shares are popping some 10%, and that's on the back of strong bookings over the holiday season, and it gave investors something they love, a quarterly dividend of 40 cents per share starting in March 2025. And due to all of that, you're seeing a number of price target raises over at JP Morgan and Barclays, and even an upgrade by HSBC. And last up, we have another riser for you, and that is Pinterest. It's soaring 20%, and that is because AI is actually paying off over there. Apparently, their AI tools are actually more lucrative for businesses because they're better able to target people, and that contributed to a record quarter. For the first time, its revenue came in at above $1 billion. And yes, John, you can see my Pinterest board after the show.
Stock is up by 20%. I'll take a look. I've got one too.
He does.
I do.
For what?
A renovation that I didn't do, but it still exists. You want me to share it with you?
Yeah, I would love to. I'm sure it is. It's just, Pinterest. I don't have a Pinterest
I was
page.
surprised by my experience on Pinterest, but I'll share that another time. Yeah.
Even the positive experience.
Sure, lots of things going on there that I didn't realise.
I had a Pinterest board.
What's going on in Pinterest?
Anyway, on our radar this morning, Amazon delivering a disappointing outlook. CEO Andy Jassy warning growth could be lumpy and hinting the company could face capacity issues in its cloud computing division, echoing the concerns we heard from Microsoft earlier this week. That stock here, Lisa, down by about 3%.
So this goes to the idea that if this holds, we'll have 4 of the 6 Magnificent 7 stocks down after reporting earnings at a time where they all can't keep up with demand, which is a great problem to have. Is this the beginning of a shift where investors no longer tolerate massive expenditures because ultimately valuations are too high, even if you have wonderful words that accompany it and promises of incredible things in the future? Hard to say this is a deep-seek moment and more an excuse to sell at very high valuations.
All this warning on AWS growth constraints, you sort of forget that they had a great holiday quarter. And I find that very interesting because they've been dealing with the likes of Shane and Temu. And the reason why I'm focused on that is because I actually wonder if they're going to be able to squeeze those Chinese e-commerce companies even more because of Trump's exemption on de minimis. Basically, that tariff meaning those packages under $800, they're going to be the ones that are going to have one of the biggest issues with this new tariff policy.
Could get more expensive, that's for sure. Putting it all together, it's not been a blowout quarter for the tech names relative to expectations, has it? Some really mixed results across these big names.
It's been remarkably soft in terms of the takeaway. One thing that I thought was really interesting about Amazon, they mentioned the currency drag, and this is something that we've talked about, the idea of strong dollar really impeding some of their abilities to meet expectations. They would have been at the top end of their guidance if they hadn't taken a $700 million hit because of the strong dollar. Watch this space, because you're going to hear this more from companies as they try to navigate the international space.
Particularly if you've got exposure to Japan.
Correct.
Because that story's changed a lot in the last month too.
Well, and this to me goes to the story of just little tweaks in the global picture can make a big difference to companies at a time when they're really kind of climbing to the sky and people are losing patience.
Can change a lot. To your point, some of the biggest volatility we've seen over the last few weeks in foreign exchange, particularly on Monday. That was wild. Let's turn to another story. A judge temporarily delaying the deadline for federal workers to decide whether to accept an offer to leave their positions with pay through September. The judge blocking the Trump administration from implementing the offer until he holds another conference on February 10th.
So the deadline went. It was yesterday. Basically, the judge wants to look at more the legality of this deferred resignation program. What I will say is that more than 50,000 federal workers signed up for it. That's 2% of the workforce that already signed up for it. Now they're extending it. Potentially, we will see even more sign up for this. Very interesting, though. This, I think, will go back and forth in the courts.
This is just the beginning of this push from Doge, isn't it? You get the real feeling that they believe that this could be a big offset for the tax cuts that they're set to deliver, but a lot of people would question how easy that might be.
I walked away from Scott Bessent's interview yesterday a bit more confused about the process of Doge and exactly how it would go through with some of these cuts. It is being attributed as some sort of accounting apparatus that's going in and trying to figure out where to get efficiency. Who's going to be able to implement that? And they're going to be working that out through the court system.
Final story here. The Kansas City Chiefs, Philadelphia Eagles gearing up for Super Bowl 59 on Sunday in New Orleans. The Chiefs looking for their third straight Super Bowl title. President Trump said to become the first sitting president to attend the game in person. That's remarkable, isn't it? Didn't know that.
Yeah, and it is remarkable. It's the reason why Pam Bondi, the new attorney general, and I was at her swearing in actually this week in Washington, the next day, where did she go? She went there to talk to law enforcement just to make sure that this is going to be incredibly safe because the President of the United States is going. I have to say, it is a smart political move. I can't get over how silly it was that Biden decided not to take that Super Bowl interview last year. You know, you're going to have eyes of the entire country on you on Sunday evening.
You know what the eyes are going to be on? So Travis Kelce is going to be playing with Patrick Mahomes and Travis Kelce's girlfriend.
Is this Taylor Swift's chat?
Well, you had Trump basically come out and say, I hate Taylor Swift because she endorsed Kamala Harris. They're both going to be there.
So he's supporting the Eagles?
Well,
I don't know. He loves Brittany Mahomes and he loves Patrick Mahomes.
He loves
I think
them.
he's going
so
Chiefs.
It's just this real interesting tension because...
Put them in the same box?
Yeah, that's what I think.
I'll tune in for that.
I think that would be good.
I can't believe it's still Sunday night. Are we actually going to do this on President's Day weekend soon? Are we making that change? I think we are looking at making that change, aren't we?
Because you're not going to be able to watch it in real time.
For me personally, I would love to stay up and watch this.
Well, okay, maybe just wake up at 3 and watch the replay with a bowl of chips.
It's not the same, though, is it? You know, you want to live it. You want to live it. Anyway, January payrolls data out in just under 1 hour's time at 8:30 Eastern. Ellen Zender of Morgan Stanley writing the following. Annual revisions typically make the January jobs report difficult to sift through, but I don't expect those to change the underlying picture of a still strong labour market. Ellen joins us now for more. Ellen, good morning. It's good to see you.
Good morning. Happy Friday.
Happy Friday to you as well. We've had some pushback to that strong view of the labour market. We heard from Citi earlier on this morning, who made the case that this is a low-churn labour market. Layoffs are low, but quits are low, and you've seen this on repeat over the last several months. And they make the case that's inconsistent with a healthy labour market. What would you caution back?
We're looking at headline numbers here, right? So you look at 150,000, 180,000, even 120,000, right? Those are strong net job gains. But we economists, always want to see more churn in the labor market. It means that people are more, have a more healthy view of their prospects of leaving a job and getting another job. There's a lack of churn in the U.S. economy overall. So I don't push back on the city economists saying there's a lack of churn. There's a lack of churn in the housing market. There's just a lack of churn overall. And you want the economy moving and shaking. It means you're on better footing. So is this the best labor market that we've ever had? Probably not. It's slowing, but it's still darn good. And we're going to see numbers that are fine today with some wildfire effects. We are going to have to watch going forward federal employees, right? That is going to be a hit. We almost act like it doesn't matter if we reduce government employment. They make more than the median wage in this country. That's still a job. That's still aggregate demand. Now, the ones that are taking the payout, and we said, right, we're almost surprised at how many people have signed up for it. Why not? I mean, for 8 months, you get paid 8 months worth, and it does not bar you from going to the private sector and looking for a job. I would take it.
Ellen Zentner, good to know.
I take
it
it
seems
too.
like, on a Friday, you're in the same place that we're in, and I just wonder, especially because you're wearing 2 hats of chief economic strategist, but also someone who's leading on investing. Do you care about this non-farm payrolls? We've had people come on and say it's just basically an exercise in noise, or it's going to be, as John put it, just a random number generator. The numbers are all distorted. How much is this going to matter?
Look, so I think, the high-frequency data can be frustrating, but you step back and they do tell a full picture of the economy. And I am so thankful that we do have the agencies that we do that put out robust data. And yes, I'm sure you've had many guests on talking about the response rates being lower over time and the question of the integrity of the data. But in the United States, we enjoy an incredibly robust landscape of data. And so I do care about today's print, but what it tells me about the bigger picture. And the bigger picture is, again, going back to the lack of churn. It's saying we still have low unemployment rates. We've got natural disasters that knock around the data. We've got government and DOGE that is making for an uncertain environment for employment going forward. But what we know right now is that the labor market's okay. Inflation is coming down. And the Fed doesn't need to do anything for as far as the eye can see.
Where do you expect the lack of conviction that some CFOs have right now because of policy uncertainty, because of a lack of churn, a lack of concrete knowledge of what's to come? Where would you expect that to show up in terms of hiring or investment?
So I think it continues to be the case like today that we're not laying off, but hiring just continues to slow. And so what you look for is that turn when it actually comes to layoffs, because labor is your largest business cost. And if other costs are rising, where are you going to cut? It's always going to fall on labor. And so we're starting to get the first sentiment surveys among business where they're really getting concerned about tariffs and the bottom line going forward. Jobs will be next. So you have to look at jobless claims and see, do those start to pick up?
So policy in Washington could be the catalyst, you think, for that turn in the labor market?
Yeah, I think right now the uncertainty is over, is it talk, is it not, what gets implemented and when? And then if things get implemented, you can start to say, what is that going to mean to my bottom line, and how do I have to adjust costs accordingly?
But if we're just in this moment of basically treading water with policy, uncertainty on where Donald Trump's going to go, what do you do as an employer?
Uncertainty creates paralysis. Uncertainty creates policy paralysis for the Fed. Uncertainty creates paralysis for business decisions, household decisions. It just dampens the overall, underlying, I don't want to say froth, just underlying activity in the economy. And we just sort of hunker down and see what's going to happen. It's just an extremely uncertain year, an extremely uncertain start. I mean, President Trump signed more executive orders in the first 7 days than all of the past presidents in the first 100 days. And you see how many actually get acted upon, not many. And as you stated, right, a lot gets tied up in the courts. But that's the uncertainty.
This is the piece of the tariff story that I don't think was discussed enough earlier this week. Lots of things can happen when tariffs go up. Exporters could drop their prices. But if it ends up with the importers, because by definition they have to pay the tax, they've got one of two options, basically. Pass it on to the consumer. We talked about this. But if you're knocking on the limits of consumer price tolerance, you might have to take it on the margin. And if you're doing that, to Ellen's point, that's where you start to see the weakness in the labour market, because they look to cut costs elsewhere and pull that lever that they've been reluctant to pull over the last few years.
Ellen Zentner repeating something we heard from Jonathan Pingle, where suddenly those unemployment claims become that much more important at a time where people are looking for that signal that that's the lever people are pulling.
And then just a final question. You mentioned the wildfires. I was surprised it didn't come up in the news conference. How much disruption are you expecting from the wildfires, from the cold weather, particularly on the East Coast, over the past few weeks?
So I think it could be as much as, say, 40,000 off the top of payrolls. I mean, the thing is that we're going to get that within a report with annual benchmark revisions as well. So sifting through what that means, very difficult. But I think the overall number we're going to see is still going to be an okay number, and then you just assume it would have been higher if not for the wildfires. Does that mean the wildfires don't matter? Absolutely not. I mean, these people are displaced. They have to go somewhere. And these climate events are creating a lot of regional displacement around the country. We're still seeing it from the hurricanes last year. It's the fact these things are back to back to back. We're not just dealing with one major climate disaster here and there. These are things that are coming back to back, and it's extremely disruptive.
We're expecting a big effort from Mike McKee at 8:30 Eastern Time, going through all these details. Ellen, it's good to see you. As always, thanks for dropping by. Thank you. Ellen Zentner there of Morgan Stanley. The jobs report just around the corner, about 46, 47 minutes away. Let's get you an update on stories elsewhere in the meantime. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Trump fired the head of the Federal Election Commission, but she doesn't plan to leave. In a post on X, Ellen Weintraub wrote, "There's a legal way to fire FEC commissioners, and this isn't it." Weintraub was appointed to a 6-year term more than 20 years ago. Under federal law, commissioners are allowed to stay past their terms until a replacement is named. Apple is getting ready to unveil a long-awaited overhaul of its low-cost iPhone SE. The new model is expected to be unveiled next week and go on sale later this month. The new model will include Apple Intelligence and is expected to be more expensive than the current SE model, which sells for $429. And Los Angeles Dodgers star Shohei Ohtani's former interpreter Ippei Musuhara has been sentenced to 57 months in prison for stealing $17 million from the baseball star. He was ordered to pay Ohtani back and pay back over $1 million to the IRS. Lawyers for Mitsuhara blamed a gambling addiction and had requested a much shorter 18-month sentence. That's your Bloomberg brief. John?
Yahara, that's how rich we need to be. So rich that you don't notice $17 million has gone missing. Can you imagine?
Is that the metric now that we have?
Absolutely.
Yeah, well.
That and buying Ken Griffin's dinosaur, right? Those kind of fossils.
Oh, yeah, that was cool.
That was cool.
That was
right?
cool.
It's like
if you're a kid,
a childhood dream.
Exactly. My nephews looked at that and they were like, "I want a dinosaur."
What would you do if you won the lottery? You'd buy a dinosaur, right?
Go to space, buy a dinosaur. You know, some things don't change.
Up next on the program, we'll talk dollar strength.
The strong dollar policy is completely intact with President Trump. He re-emphasized the importance of maintaining the dollar reserve currency status.
That dollar getting a little bit weaker. We'll catch up with Jane Foley of Rabobank in just a moment. From New York, you're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures on the S&P totally stable and unchanged. Still going towards a week of gains on the S&P 500. The Nasdaq 100 going nowhere as well. On a Russell, the small caps just about positive by not even 0.1%. The main event, of course, is a little bit later this morning at 8:30 Eastern Time with the payrolls report just around the corner. Let's talk about the bond market. So much attention on fixed income this week. Thank you, Treasury Secretary Scott Bessent, making a point that him and the President of the United States are very focused on the 10-year yield and not the rate at the Federal Reserve. That's a shift of emphasis from this administration.
What he wanted to focus on was the mortgage rate and the effective rates that people borrow at, saying that that's going to be the true tell. And he pointed to the idea that the Fed cut by 50 basis points and caused the real borrowing cost to go up. That's the reason why they're so focused on that.
The 10-year 4.43. Out of surveillance this morning, dollar strength.
First of all, the strong dollar policy is completely intact with President Trump, and I was very happy at his Economic Club of New York speech in August when he re-emphasized the importance of maintaining the dollar reserve currency status.
So here's the latest this morning. The US dollar poised to end the week just a little bit weaker amid tariff uncertainty and just ahead of the payrolls report in about 40 minutes' time. Jane Foley of Rabobank writing, the political news flow in the US combined with Friday's US jobs data release suggests plenty of scope for volatility in the dollar crosses. Jane joins us now for more. And Jane, we've had exactly that over the past week or so. On Monday, a lot of it was trade related against the peso, against the loonie, saw a bit of it against the euro as well. But the one to watch, and I think we're both on the same page, I think we all are, the one to watch has been the Japanese yen over the last month or so. Jane, what is behind that big move?
You know, I couldn't agree more. I think the yen is by far the most exciting currency this year, and we've seen that in its performance. It's been the best performing currency in the year to date, and that really is related to the market revising, taking another look at its expectations about Bank of policy or Bank of Japan interest rate policy. We've had a couple of speeches, for instance, which really have steered the market at what they really need to be looking at, and that isn't necessarily the workers' real wage numbers. It's the household wage numbers. There's been real changes in the Japanese demographic, more part-time workers going in, which has affected those numbers, and the market as a consequence is viewing the Bank of Japan in a more hawkish light, more interest rate hikes coming, and a better outlook really for the Japanese yen.
Jane, do you expect the volatility to be in specific pairs and not necessarily just driven by the fact that the dollar is going to continue to strengthen ad nauseum? And I'm talking about this in the same light that the ECB might take a page from what we saw of the Bank of England and cut rates even in the face of somewhat stickier inflation.
I think there will be a lot of volatility, probably predominantly in the dollar crosses, but there is a lot of news flow elsewhere. And because you mentioned the ECB, you mentioned the euro. We, of course, have Germany really mired in pretty weak growth. We've got political issues, France and Germany. France, of course, has some good news this week in the shape of its budget, but there really is still a fragmented government in France and probably in Germany as well as we go on. And that's not a great situation for Europe. It's got a weak leadership in its primary countries of Germany and France at a time when Trump is threatening the EU with tariffs. So a difficult position, I think, for the Eurozone, and therefore the possibility of more volatility from euro-related factors, irrespective of the politics in the US.
Jane, just a final question on Europe. Plenty of debate over on the continent today about where the neutral rate might be. I'm not sure why we're still having a conversation about neutral at the ECB when some people might suggest the economy is weak enough to have a real conversation about getting accommodative and maybe getting accommodative quickly. Where do you stand on that?
Well, we are having that conversation. I think we've been having that conversation, for quite a while, and we'll have that conversation irrespective of exactly where that neutral rate is, because you've got to remember, that will change over time. So it's only a basic concept anyway. But, one thing that the ECB, has really got to and is very wary about is the possibility that inflation could remain sticky. And that's what we still have in Europe, in the UK and in Europe. And that is going to be potentially a break on some of the expectations that growth will fall and create a faster pace of easing in these central banks, both the ECB and the Bank of England.
Jane, appreciate your time on the FX market. Some big moves over the past month in dollar yen. Jane Foley there of Rabobank. Just finishing on the euro, I want to return back to the United States. When we closed out 2024, we were having this massive conversation about sequencing. It wasn't just policy changes, but the sequencing of those policy changes that mattered. And we're getting an idea about sequencing. We're leading first with trade, and then we're shifting towards taxes. I think if we started with taxes and moved aggressively on that, we'd have a different conversation about where rates need to be, what the dollar's going to be, about how hot this economy might be running. But because we started with trade, the conversation naturally drifted. I would say it's way too early in the year and far too early in the administration to draw any conclusions right now and extrapolate them out. If you start to come through with a big tax package and Republicans start to get on side about what that tax package might be, its size, and where the focus will be, all of a sudden we shift back to where we were at the end of 2024. Running the economy hot, potentially being constrained by the bond market, plenty of dollar strength and sucking all that capital in from the rest of the world. That conversation can shift really quickly.
Right now, people are not seeing the gravitational force to push through a tax bill in short order that could potentially support that type of running the economy hot. The fact that we were even having a discussion earlier about whether this would be a tax bill in 2025 or 2026 gives you a sense of the messiness that people foresee with this process. It is easier to have an executive order about tariffs. It is much harder to pass through a bill with all the potential interest involved, even throwing a lobbing in the carried interest tax. But it just highlights how much you're going to have these hot potatoes that might not make a huge difference on the budget deficit side of things, but that do make a huge difference with respect to people's emotions.
In early November, the emotions were around a tax bill that might take several months. Get it done really quickly, hit the ground running, one big, beautiful bill. And here we are talking about the potential of it drifting into 2026. Terry Haynes of Pangea made the point, there are too many reasons behind the President of the United States, too many reasons, too much emphasis to not get this done in 2025.
This is all true. The longer it drags out, the more we're talking about uncertainty. And even if policy isn't great, companies want certainty more than anything else.
The conversation shifts back to the data. 8:30 Eastern Time, 34 minutes away, the jobs report. Joining us, Nadia Lovell of UBS, Mike Collins of PGIM, Torsten Slog of Apollo, Jeff Rosenberg of BlackRock. From New York City, the third hour of Bloomberg Surveillance. Up next.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
I think the most important is the labor market. I think some of the data has been overstating the health of the job market.
We're going to see more challenges to labor supply.
We would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are in fact sustained.
Going forward, I do think that you'll see a payroll impact estimate from slowing immigration, but it'll be kind of harder to figure out how that happens to actual unemployment.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The jobs report 30 minutes away, 8:30 Eastern time. It drops. The estimate, the number we're looking for, 175. The high out there at the moment, 240. The low, 105. The equity market doing nothing going into this. Equity futures totally unchanged on the S&P 500, on the Nasdaq, and on the Russell. We're just about positive by 0.1%. The one to watch, maybe the bond market. The 10-year right now, Lisa, 444.
It is just really shocking to think about how far we've come from the last jobs market report. When people were worried or concerned that maybe we got a reacceleration in inflation and that yields would climb much more significantly and that maybe we were running this economy too hot. That has been taken out. This is a market that is girding for some potential evidence of cracks in the labor market that could undermine the American exceptionalism story. Barring that, it might not make a dent in markets.
Might not make a dent, but Jonathan, you were right. Maybe we need to look at the bond market because is that going to be the regulating force on some of these policies that we want, that this administration wants to enact? And they added that list last night when it comes to their tax policy. Everyone's talking about the uncertainty of tariffs. We have some of the bad news. They want to see the good news. So the reaction to the markets is going to be more interesting than the actual NFP number.
Caroline Leavitt, the press secretary, coming out with a long list outside of the White House yesterday. The president's tax plan to end taxes on tips and overtime, new cuts for Made in America products, extend TCJA from 2017. You're all familiar with that. Expand the state and local tax deduction. And the list just kind of goes on and on.
There are things that potentially could be offsets, but they're minor. The rest of them are all saying, you get a tax cut, you get a tax cut, to Anne-Marie's point about an Oprah Winfrey tax season, how much gets passed and what does that do to the budget deficit? And does the 10-year respond to that in a significant way? We'll have to see.
And I love the carried interest loophole. This came out of nowhere for the Republicans. The Democrats couldn't do it when they had power. Someone writes in, all someone needs to do is interview Steve Schwartzman about carried interest, and the elimination chatter will be over. I tend to agree.
Over for who? For the President of the United States? For members of Congress? They'll face midterms. They're only just around the corner. If they don't get something done on taxes, there'll be big pressure on them. These were big campaign promises from the president, and they were very well supported.
Big campaign promises, and everyone thought the idea of no tax on tips was going to go away after the election. He has brought that up constantly. That is going to have to be in this bill if he's the driving force behind it.
So the economic data so far this week has been softer than expected. It started with jobs openings, then it went to the ISM services, prices paid pulled back, good stuff. Still in expansionary territory. I don't think there's anything to worry about here. Jobless claims a little bit softer, but the heat comes out of the American economy. How long before the heat comes back in and we start talking about rate hikes again? Torsten Slok of Apollo, you seen this morning? Published this. The last Fed cut was in December, and the number of months from the final Fed cut to the first Fed hike has historically been as low as 7 months, implying that the Fed could hike rates in June.
What would it take for them to have to do that? Right now, they are completely on hold. Most of them are leaning still to the dovish side of cutting. You did get some Lori Logan speak talking about maybe we're at neutral and there could be an equal opportunity on both sides. What kind of policy would have to come through for the Fed to really put a hike on the table? And what kind of runaway increase in longer-term yields would you have to see where it would be politically feasible for the Federal Reserve to hike rates?
What kind of number would we have to see in 26 minutes? I'm not sure any kind of number.
Come on. You think that if we get 600,000, they're going to be, oh, we're hiking. No, they'll say it's fictitious.
How many people are going to believe that number?
Exactly. It'll be a fiction.
We're on the same page. I'm not going to argue. It's Friday.
But we can make it exciting.
We can. You should try. Maybe try harder, given the job you've done so far this morning. Coming at this hour, Nadia Lovell of UBS saying stocks still have room to rally. We'll catch up with Torsten Slok of Apollo with US payrolls just ahead, and Jeff Rosenberg of BlackRock on a Fed that is in no hurry to make another move. We begin this hour counting you down to the latest payrolls report due at 8:30 Eastern Time. Nadia Lovell of UBS writing, while we think there is more to go in equities, we emphasize the importance of diversification and hedging strategies to navigate policy uncertainty. Nadia joins us now for more. Nadia, good morning.
Good morning.
Before we get to the policy uncertainty, let's talk about payrolls. What are you looking for in 25 minutes?
As you said, the numbers are noisy at the start of the year, and so, probably close to 200K, but as we've all noted that this might not have any indication for the market. I think that, even Walla has put more credence on something like JOLTS. I think that's more indicative of where the job market is. We've seen a little bit of softening, nothing falling off of the cliff, and so we'll see.
Saw that repeated in the ISM, saw that repeated to some extent in jobless claims as well. What kind of economy is this president inheriting in 2025?
A pretty strong one. I mean, you saw what fourth quarter GDP above trend. We're looking for above trend growth to continue this year. The job market, again, as we know, remain healthy. And I think despite all the tariff noise we saw earlier this week, ISM manufacturing finally back in expansion territory, and we have 3 months of new order, above 50. And so I think that was missed to show that the fact that you could start to see some recovery in the manufacturing side of the economy. And so overall, the economy seems to be on good footing.
Which is the reason why, and you came in, and I'm going to steal some of your thunder, you were talking about some of the investment, the capital expenditure investment that some of the big tech names were coming up with, $100 billion, $75 billion just for this year alone. Where is that money going? Are we going to see that giving some jobs boost or some sort of manufacturing boost to the rest of the economy?
We are seeing, and we saw that last year as well. I mean, we ourselves coming out of the earnings season had to lift our CapEx expectations for the four hyperscalers. I mean, before we were looking for 25% growth this year, and we're now looking for 35% plus, and that's over $300 billion. And so we think that that will benefit the data centers, the enabling layer of the AI story, which we think has disconnected the pressure that we've seen over the last week, particularly around DeepSeek. So the fact that the hyperscalers are spending more mean a lift for things like semis in terms of earnings.
Then do you think that it is a mistake that this market is more focused on the possibility of cracks in this labor market than the idea of a reacceleration like Torsten Slok was talking about?
Reacceleration is possible. I think that yes, I would agree that the labor market or the economy itself has not seen any major crack, and we have a potential for a re-acceleration. Of course, that has some concerns around inflation. Inflation right now seems to be coming down. We think that it will start to come back down again, and we think that you could get to core PCE, sort of around 2.5% by the time we get to the mid-year. We don't expect the economy to overheat. I think right now companies themselves as well are in sort of some companies are in a wait-and-see mode to kind of see where policy eventually shakes out, particularly government policy.
And when it comes to tariffs, and it's something
Absolutely.
you have a lot of thoughts on. You say you're expecting aggressive but selective.
Yes.
Explain.
Yes. So we are expecting selective tariffs, not universal tariffs. What we're looking for really is lifting the effective tariff rate for something like China. We think that that's likely going to triple to close to 30%. Now, we think that the president will continue to negotiate with some of our close neighbors like Canada and Mexico. We see that grace period has been given to those two countries. We'll see what happens after 30 days, but we're not expecting any sort of significant tariffs against Canada and Mexico to really stick. It's just really complicated. How the complexity of enforcing that, particularly in something like autos that crosses the border multiple times.
Right, and we already are in a trade agreement with both these two countries,
Exactly.
but the trade agreement's coming up, so maybe this is an opening salvo into those conversations.
To pull forward that.
You didn't mention Europe, though, and the president says the European Union's next. What are you expecting?
10% has been floated out there. We do expect some increase in Europe, but again, I think China is really going to be the focus. We're all watching, of course, the April 1st deadline. We know that the president has asked the federal agencies to come back with reports for countries that we have major trading deficits with, and a lot of those countries are really in Asia.
Well, Chris Verone was on earlier, and he talked about Christine Lagarde talking about peak pessimism, so he wants to be exposed to Europe. Would you want to be exposed to European equities now ahead of tariffs?
It's a great question. We actually have a call on Germany, the DAX specifically, a tactical call around that we put in place back in December, again, ahead of the German election in a couple of weeks. Also, you could get some sort of, this chatter of some kind of peace agreement between Ukraine and Russia that still remains to be seen. And so you also have this election with a lot of the candidates having a pro-growth policy. And again, as I noted earlier, we know that Germany has a lot of exposure to production, and with ISM manufacturing starting to pick up, even some of the companies are suggesting a bottom in terms of the inventory cycle as well. Like that could be beneficial to Germany.
That's quite a call. You're up 10% on the DAX so far this year. Euro Stoxx 50 is up by more than 9. When do you close that, if it's tactical?
We'll see what happens after the election. But when we think about tactical, we're thinking about 3 to 4 months.
Okay. Were you thinking about 10% upside when you initiated that call?
No, it's coming in better than we thought. We were not looking for this sort of massive outperformance versus the U.S. market, but we'll take it.
At the same time, I want to go back to something that Chris Verone was talking about, and it relates to the money that's going into the DAX and the money that's going right now into the entirety of the European market, which is follow the flows. And the biggest trend has been to him the dollar-yen, and the fact that suddenly, after years and years of money moving from the east to west, we're starting to see a shift. And it's because of some fundamental reasons. And that's going to lead to an outperformance of the rest of the world versus the U.S., which is highly valued. Do you believe that this is the beginning of something that is more sustainable in that type of way?
No, we continue to think that the U.S. will outperform. There will be pockets in which these other regions outperform like we're seeing with the DAX, but we ultimately think fundamentally when you look at our exposure to tech particularly, the spending that is happening there, the AI story that we think remain intact, and that ecosystem, not only tech but also industrials, as well as the utilities companies as needed for this infrastructure build out, we think that the U.S. stands to benefit.
So a lot of people have wondered if the utilities play was done because of some of the deep sea concerns and this idea that maybe it would be less energy intensive. You push back against that. You think that that's absolutely the wrong take. Why?
Well, look at it, right? Last week we saw, some of the independent power companies down as much as 30%. They're not down so much anymore. So that correction has been bought right away because it does not change the dynamics that there's an increased need for energy. And it's not just about AI. It's sort of the energy transition as well. It's, cloud computing, it's quantum computing. There's all of this technology that's going to be needed that increased power is required. And so we continue to advise our clients when you see that disconnect in the market, disconnect from fundamentals, that is a buying opportunity, despite the fact that we think that volatilities, you have to use those opportunities to get into things like the utilities, particularly the independent power companies.
Nadia, love doing this with you every first Friday of the month. Nadia Lovell there of UBS. Thank you. Thank you very much. The jobs report just around the corner, 8:30 Eastern Time. The estimate 175. Just got a message. Eggs secured over at Whole Foods. Managed to get some. So there you go.
Eggs secured?
Eggs secured.
Oh, yeah?
Just getting a confirmation
How many?
right now. A dozen.
A dozen.
How much?
Yeah, that's the
I haven't got the price in front of me. I can share that with you in the commercial break.
This
if
is
you'd like.
literally what we were talking
The
about
audience wants to
yesterday
know.
with the idea of someone stealing the eggs from the truck and then offering them to you
Sure.
on Canal
Do you
Street.
want me to sell you
You're
some
basically getting people pitching you. The eggs are secured. Where do you want to meet?
I'll be on Canal Street this weekend next to the guys selling the Gucci handbags.
You got the stuff?
I'll be dealing some eggs on
I
the
got the
corner.
stuff.
Yeah, all right. Let's get you an update on stories elsewhere this morning. I won't, obviously. I'll be eating them. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. We start with President Donald Trump's tax priorities, which you were discussing earlier. He outlined what they were in a meeting yesterday with Republican lawmakers. Trump called for the end of the carried interest tax break enjoyed by private equity and wants to cut special tax breaks for sports team owners. He also pushed for the expansion of the SALT deduction. Meanwhile, the Israel Defense Forces says its Air Force conducted a strike in Lebanese territory on 2 military sites. The IDF says the sites contained Hezbollah weapons, which is a violation of the ceasefire agreement. And a plane carrying 10 people went missing in rural Alaska on Thursday during bad weather. The flight from Unalakleet to Nome is likely the third deadly aviation disaster in the U.S. in just 2 weeks. The Associated Press reporting that rescue crews are scouring the ground for any sign of the wreckage of the Cessna jet. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. That's tough to hear. That really is. More from Yahara in about 30 minutes' time. Up next on the programme, the morning calls. Plus, we'll catch up with Michael Collins of PGIM. Fixed income, drum beating to the payrolls report. The payrolls report 16 minutes away from New York. You're watching Bloomberg TV.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The jobs report is 13 minutes away. An hour after that, the cash open. Dictating the price of things will be that jobs report, because right now this market's going nowhere. Equity futures totally unchanged. In the bond market, we're going nowhere too. The 10-year 443.83. The arms are crossed. Ramo's hyped up.
It's Friday, Bravo.
You know,
Come
hold on a
on,
second. I
let
think that
loose.
there is a tell in the fact that people are sort of paralyzed. That people don't have anything to say about non-farm payrolls.
See this every month, don't we?
Sort of. It has a different tone to it because there has been this exhausting running in place where you're trying to play whack-a-mole with all the different proposals, game out what they could potentially mean, and then they all get disrupted in the next 2 seconds. So, you know, if we get a headline number, we've just heard 15 people tell us that it's fictitious because the people will explain it away, it becomes very hard to even know where to begin to look.
Payrolls deniers aren't new. Okay, that's been an industry for a long, long time.
Payrolls deniers.
Yeah, that's what they're called. The payrolls deniers.
Oh, is that right?
Yeah. They've been around for years.
Okay.
That's not new. I think what's new and why we're taking even more less emphasis away from this jobs report is the expected policy changes from the administration. Policy is just absolutely paramount. And I'd say also, because of the Federal Reserve, has to take a back seat to what's going to happen with fiscal. So I think it's policy from the White House and Donald Trump, the president.
You add on top of the policy uncertainty the fact that they're going to revise it by almost 1 billion jobs, and the fact that all these numbers have gotten pretty messy because you haven't gotten the same kind of response rate. It makes for rather dizzying Friday.
And the accusation that they were inflated for political reasons,
well,
like
I do buy that.
payrolls deniers.
But, okay, but
Make NFP great again.
I'm not saying I buy it. I'm just saying that industry exists. Same group of people.
There's an industry for everything.
Every single month, of course.
Including eggs.
Let's get you some morning calls, including that too. First up, Wells Fargo cutting its price target on Amazon to 207, citing slowing revenue in Amazon's cloud division. That stock is down by 3%. Your second call from Citi, downgrading Nike to neutral, noting a lack of new products and continuing top-line pressures. That stock is down by 0.6%. And finally, Morgan Stanley downgrading Elf Beauty to equal weight and slashing its price target, highlighting category weakness and volatility in the space. That stock is getting hammered. In the pre-market, it's down by 25%. Let's turn back to the labour market. January payrolls just moments away. The estimate in our survey expecting 175,000 jobs and unemployment to hold steady at 4.1%. Joining us now is Mike Collins of Pigeon Fixed Income. Mike, welcome to the programme, sir. Good to see you. What are you looking for in 11 minutes' time?
You know, I have no idea, Jonathan. It's a total crapshoot. And to your point earlier, I think the markets are really taking it with a grain of salt. You know, there are so many big revisions that are going to be associated with this. And remember, these jobs numbers, when we get them first Friday of every month, they are backward looking. And then they do get revised as well going forward. So it's all about where the economy's going, where the labor market is going, and where inflation and obviously interest rates are going over the next 6 to 12 months. And again, I think we had a big retracement in rates, and it feels like we're getting closer to the high end of fair value here.
Mike, I was hoping that you would come out and say this is actually going to be a really important jobs report. I personally am looking forward to it and have so much to say about it. I do think there is something that is incredibly telling about where markets are positioned. And Priya Misra nailed this when she said, it seems as though there is an asymmetrically positioned market to respond much more to a downside surprise than an upside surprise. Putting aside the noise and all of the confusion around these particular numbers, Mike, do you agree with that right now this is a market that feels like there isn't necessarily a risk of overheating, but there is a risk of cracks forming in the labor market?
Yeah, I'm definitely in that asymmetric camp with Priya as well, Lisa. And I think it's really a function of what's priced in, right? Like right now, there are 2 Fed rate cuts priced in sometime in the next 12 months, and then that's it for the next 10 years. Okay, so there's very little movement to the upside here at risk. I mean, yeah, you could retrace back to that 480, get into the 4.5 to 5 zone on the 10-year Treasury. I call that the overshoot territory. That's a zone where rates are way too high and unsustainable. I think 3.5 to 4.5 is kind of the big fair value range on long-term 10-year Treasury yields. And personally, I think the 10-year Treasury is going to spend more time in the bottom half of that range from 3.5 to 4. So we overshot, and we've overshot a couple of times in the last few years, and it doesn't stay up there for too long. Now, even close to 4.5, rates are clearly in the buy zone. And think about the downside risk. We just talked about the upside. If there is a downside surprise in the labor market, in growth, in inflation, in geopolitical risk, in policy risk. I mean, those 2 cuts that are priced in, could turn into, 8 or 10 pretty quickly because that's the kind of dry powder the Fed has, right? They could get, cut 200 basis points overnight if there was a real disaster and get to a rate that they would probably kind of think of it as being long-term neutral. So that's the kind of dry powder. So that's where the asymmetry comes in.
Mike, I know you are bullish on bonds, on longer-term bonds, and I know that you have been for a bit. How much more conviction did you get that you had the President of the United States say that he thought the Fed made the right decision, and you heard Scott Bessent, the Treasury Secretary, come out and say he's much more focused on the 10-year yield than jawboning the Fed in one direction or another.
Yeah, I think that's really good news, right? That they're backing off the Federal Reserve. That's what they're supposed to do. They're supposed to let the Federal Reserve be independent and do their job. So that's really encouraging from a financial system standpoint, and it's really good for the long-term path of the economy and inflation, Lisa. In terms of the 10-year, yeah, if I had all of the debt that the government has, and Trump is knows debt as well as anybody, I would want lower interest rates too, right? Like I said, I think these rates are just unsustainable. Look at the deficits we have and the debt load we have and the level of interest rate we're paying, right? So it's that multiplication, that factor is the debt service that we have to pay every day, every month, every quarter. We're doing 125 billion in new auctions next week, right? It's just nonstop. And at some point, something has to give. Either the debt has to come down, or the interest rate has to come down, right? And we all know which one is the variable that's going to move the most. At some point, I don't know if it's next month or in 10 years from now, at some point, that level of interest rates will have to be probably a lot lower. And you're seeing that in other countries with a lot of debt, right? Like, obviously, Japan's raising a little bit, but our yields are still almost 4 times theirs. In China, our yields are almost 3 times Chinese yields, and they've been cutting because high debt levels just can't be sustained with high interest rates in an economy where growth is moderating.
Mike, that's music to the president's ear. Good morning, Mr. President. Balanced budget, all these exclamation points is what he woke up to his first Truth Social today. If you could get policy certainty today, because you don't really care about the jobs report, on all these ideas floating around Washington, D.C., what would it be?
If I could get policy certainty, I mean, any certainty is better than uncertainty, right? The markets, as we all know, hate uncertainty. I mean, some blend of higher revenues coming in, whether it's through tariffs or better growth, i.e., through deregulation, and, just better, corporate earnings through tax cuts, et cetera. I mean, you have to balance those, and Trump does understand that, right? It is a balancing act. The whole sum of it has to be lower budget deficits, right? I would love to see a balanced budget. The problem is to get there quickly is almost recessionary. I mean, to cut as many expenses at the government level, and you're seeing it, anecdotally already. These are pretty high-paying, secure jobs that are being eliminated. It will hit the economy, right? And you're already seeing, the combination of tariffs potentially, immigration reform, et cetera. It could result in higher inflation and lower growth. Right, that's a really brutal combination. That's kind of what the UK is going through right now, right, and that's why the Bank of England is painted into the corner a little bit, because that stagflation risk is brutal. Nobody wants that, because that's a world where the Fed kind of gets stuck and can't support the economy because inflation is sticking. Nobody wants that. So it's a real tough balancing act, and I wouldn't want to be in Trump's shoes.
Mike, we've got to go. You're going to stick with us in 2 seconds. Give me a number. The estimate's 175.
Oh, I have no idea, Jonathan. I mean, I'll take the under. I'll take the under.
Mike Collins of PGIM is going to stick with us. So we had yesterday Sonia Meskin of UBS calling it an exercise in forecasting noise, and we just heard from Mike Collins of PGIM who called it a crapshoot.
Yeah,
right?
basically. I don't know. John, why are you asking me these questions?
What a promotion for the payrolls report that drops in about 4 minutes' time from New York City. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Following days of breathless promotion, here it is. Ridiculous. The jobs report drops in about 20 seconds' time. Equity futures at the moment negative by 0.1%. The Nasdaq also down by 0.1. In the bond market, the scores look like this: 2-year, 10-year, 30-year. Your 10-year yield at the moment just about unchanged at 4.4363. The jobs report, the number we're looking for, the estimate 175. With the print is Mike McKee. Good morning, Michael.
Good morning. We come in a little bit light this month, 143,000, and last month revised up to 307 from 256, which we all thought was really big at that time. The unemployment rate, it goes down by 0.1 of a percentage point. Now remember, we have revisions to the household survey. We'll have to see if that figures into it, but it is still showing a tight labor market. Change in non-farm payrolls, as I mentioned, 143,000. To that, you have to add 100,000 more in terms of revisions to November and December. The private payrolls go up by 111,000. Manufacturing payrolls up by 3,000. Remember, ADP had said we lost 13,000 jobs there. Average hourly earnings extremely strong, up 0.5%. Last month and the forecast were both for 0.3. That pushes the average hourly earnings on a year-over-year basis up to 4.1% from 3.9%. And as I mentioned, the unemployment rate, 4%. Labor force participation rate goes up a tick, 62.6. All of this to suggest that maybe what we have seen here is the Biden administration go out on a high note. It'll be very interesting to see what the White House, the current White House, says about all this. In terms of the revisions, payroll employment for November revised up by 49,000, December by 51,000. That's how we get the 100,000 total. And then a quick look at the revisions. We are looking at a level 511,000 below what we had for the year prior to this. That's over all of the months. They divided out over the months of the past year, and we do get some negative numbers here, I believe. No, not even October. October we go up. Some people thought that one might be negative. And then in terms of the population controls, population changes 2,871,000. That is much lower than the 3,047,000 that they had already thought. So your difference is 176,000. Now all those revisions essentially meaningless to the Fed. It will get some political talk, but the bottom line is hiring a little weaker, but unemployment 4.0%.
Mike McKee, thank you, sir. We'll leave it there. First look, then, this is how we'd frame things. A tug of war between a downside surprise on a headline number and a much hotter than expected wage report. Wages, average hourly earnings month over month coming in at 0.5%, the estimate 0.3. The headline payrolls number, 143, the estimate 175. So who's winning in the tug of war? Check out the bond market. First look. At the moment, wages are. Yields are higher by about 4 or 5 basis points through the curve. At the front end, the 2 years up by 4, the 10 years up by 5. That's driving some dollar strength. The euro back down to about 103.50. And in the equity market, we'll pull back a touch, but not too much. We're down by about 0.2%. So I would say not too much drama here, Lisa, but I'd certainly, in the early part of the read of this jobs report, put a little bit more emphasis on what we're seeing on wages.
Other than the headline number, it's a screamingly bullish and actually hawkish report. Not only all of the things that you mentioned with hourly earnings, but the unemployment rate fell to 4% from 4.1%. This is going in the right direction for a fully employed America, the wrong direction if you're counting on the Federal Reserve to cut rates. The labor force participation rate went up. All of these numbers point to the idea that people are coming back into the workforce, unemployment's coming down, wages are increasing. Problem is the headline number, which we've already talked about ad nauseum, tends to be pretty messy.
Just a bit softer than expected. Mike Collins joins us now of Peach and Fixed Income. Mike, just to go through it again, downside surprise on a headline number, but wages come in a bit hotter. On the earnings side of things, month over month at 0.5%. How would you frame this report?
Yeah, I think it is another sign that the economy continues to be really resilient, right? It's been a really strong economy, Jonathan. We've just had, a 4-year GDP boom in this country like we've really haven't seen since just after World War II. We've had this kind of post-war, post-pandemic boom. Nominal GDP is up over 40% in 4 years, which is just remarkable. And you're seeing a continuation of that here with, wages continuing to be somewhat sticky, growth continuing to be pretty robust. You have to look at those hours worked, right? Those are down. If you multiply the wages times the hours worked, which is really important. That's how you calculate all, consumer income for the whole economy. It's probably a little bit weaker. So again, these headline numbers are moving all over the place. There are a lot of revisions and some to come, but it's just another sign that the economy continues to do well. Now look at the stock market reaction. It's a little negative, right? And I think that's a sign that higher rates, again, rates going up, good news in the economy means the Fed has less of a likelihood to cut is really not good news for risk assets, right? Risk assets can only kind of really do better from here, I think, if you have a moderation in the level of interest rates, because like I said earlier, it just adds too much pressure to the overall economy.
Mike, then are you basically saying you disagree with Lori Logan that this might be around a neutral rate and that actually it still is restrictive, and as long as we stay in this area, you're going to see an ongoing grind weaker in the economy?
I agree with her in that the Fed's on hold, right? They are totally on hold right now. They're on ice. They may not move at all this year. It's probably a really high probability. And if you really look at what Lori said, it's really focused on the current environment. Like right now, the Fed is more likely to just sit on their hands. I totally agree with that. But I think even Lori and certainly Powell agrees that over the long term, rates are meaningfully restrictive, right? Probably, easily 100 basis points too high. So that is the path of least resistance, but maybe not this year.
Mike Collins, appreciate it, sir. Mike Collins there of Peach and Fixed Income. If you are just joining us, the number 143, that's the headline payrolls print, the estimate 175. Lots of attention at the moment on the earnings side of the picture, coming in hotter than expected at 0.5% against an estimate of 0.3% month over month. The first move, and as we always stress, not necessarily the right move, and we'll see if this sticks. The 10-year yield is higher by 4 basis points, the 2 years up by something like 3. It's not hot enough to hike. The Fed still has a bias to cut. I'm not sure this data will constrain them one way or the other, but if you're an investor right now and you're looking at this, things are still okay based on this report.
Things are still okay if you're counting on companies continuing to do business and invest. Things might be a little less okay if you're a stock investor in some of the highest valuation stocks that have been depending on rates going lower. That ship increasingly seems to be sailing of rate cuts this year.
Torsten Slok of Apollo joins us now for more. Torsten, good morning, sir.
Morning.
We've got a few minutes to go over this one. What's your first take?
Well, a very important backdrop for this is that the framework the Fed uses for evaluating whether they should be hiking or cutting is the Taylor rule. And the Taylor rule has on the right-hand side 2 variables, namely unemployment and inflation. And both these components, namely wage inflation and unemployment, are actually pointing in a direction at least of the Fed staying on hold. Obviously, this is not enough for them to consider begin to hiking, but at the end of the day, the tailwinds to growth continues to be very strong. We have an AI and data center boom. We have strong defense spending. We have strong tailwinds also from the CHIPS Act, the Inflation Reduction Act, and we also still have relatively elevated stock price and home prices, all things that are supporting the U.S. consumer. And even before we then know what Trump will do and what he announced on the tax policy yesterday, if we do get lower taxes on Social Security, on overtime, on tips, other things, this would also be a tailwind to the outlook. So it's not clear at all that the Fed is done. And for now, I think it will be that they will be keeping them on hold, but the door is still open to hikes coming later this year.
Recent communication certainly suggests they'll be on hold. Implied in their outlook still, and their communication as well, is a bias to reduce interest rates. When you say there is a chance to hike, I understand from what we've heard from a lot of people on this program, the bar to cut has got higher. But is the bar to hike a whole lot higher? Just how low is that bar?
But think about it. Since the election, we have certainly seen animal spirits increase quite significantly. If you look at CapEx plans from the regional feds, they have all started to reaccelerate in the last 2 months. We've seen very strong improvements in a number of sentiment indicators, all pointing towards that there is still a chance that now there may be in the business sector in particular, the feeling that, well, maybe we should begin to hire more, maybe we should begin to spend more in terms of CapEx. So it is still true where we sit today. The bar is high because the expectation is that inflation will continue to come down. But inflation today is still roughly at around 3%. So we're not near the target. And the trend in the last few months on a year-over-year basis has been up. So if you take both inflation and the labor market, in particular the unemployment rate falling, and also wage growth as high as 4.1 on average hourly earnings, those are very important indicators for the Fed when they think about what they want to do.
A lot of independent indicators for wage growth don't show that same kind of heat. And as we heard from Mike Collins, some of this has to do with just the hours worked coming down. And when you do the multiplication, that's what ends up happening, is that you see that kind of wage growth. I'm just wondering, are you seeing other signs of inflation picking back up, other than eggs, that really could be sustainable in an economy that otherwise seems increasingly concerned about disinflationary degrowth impacts?
So some of the indicators that have come in, again, since the election is ISM services prices paid have really jumped higher. You also see NFIB planning to raise average selling prices have also gone higher. And the home-based data, which is much higher frequency for the labor market, is also looking a lot hotter. So there are various indicators that certainly suggest that it's not clear that this narrative is that we are in a territory where monetary policy is very restrictive. If monetary policy was so restrictive, why is the unemployment rate going down? The unemployment rate should be going up. So in that sense, there's a lot of conversations around still. Is it really the case that we are in restrictive territory? In particular, again, with policies potentially coming not only on tariffs, but also potentially coming on restrictions on immigration, and also policies potentially coming in the last few days on tailwinds to fiscal policy.
If this is actually true, that the Fed could hike rates and that policy is not restrictive in any way, does it make sense to you that stocks would fall if benchmark rates stay the same, or the idea, the prospect of Fed rate cuts later this year is taken off the table?
Well, the main reason why stocks are falling, in my view, is that 40% of the index is the top 10 stocks that are really the Magnificent Seven. And they have such a big weight, and they are so sensitive in the risk parity models to what interest rates do. So if rates are now a bit higher and higher for longer, then, of course, the Magnificent Seven do tend to trend lower. So I think a very important answer to your question is that the Magnificent Seven and the tech companies make up such a big share of the index. So that's why we have seen some broadening out away from them. But the difference in performance between the tech stocks and the S&P 493 continues to be very important.
Torsten, you're talking about these tailwinds potentially from the policy in Washington, D.C., but how much do you think Trump is willing to expand the deficit?
Well, the Committee for Responsible Federal Budget scored what came out yesterday and found that it would increase spending by 5 to 11 trillion over the next decade. So in some sense, it all depends on exactly what comes through. And we will, over the next 6 months, have a lot of budget discussions, including culminating with the debt ceiling in June. So let's see where it all goes in terms of what the ultimate fiscal impulse will be. But it's clear that at least what came out yesterday did not point in the direction of fiscal consolidation, but pointed in aggregate in the direction of tailwinds to growth.
Let's talk about where we are right now. If you are just joining us, 12 minutes ago, the jobs report came in with a downside surprise on the headline number, 143 against an estimate of 175 on non-farm payrolls, but an upside surprise on average hourly earnings month over month, coming in at 0.5%, the estimate 0.3. Unemployment dropping back to 4% from 4.1. The estimate was also 4.1%. So that unemployment scare of the summer is over, dead and buried. The Federal Reserve, of course, was a little bit nervous about that and delivered 100 basis points of rate cuts across a number of meetings to close out last year. Now we're firmly on pause. We were talking a lot about the revisions for 2024. The average monthly gain has been revised to 166 from 186. And I think there were some economists who were looking for something a lot weaker than that.
Which is the reason why people are looking at this and saying, wait a second, we were expecting last year to have even less strength, and actually it was pretty strong. It just goes to undermine the fear that we had at the end of last year that caused those rate cuts by the Federal Reserve, and raises questions. Is this really a market that's so susceptible to cracks forming if there is a policy that hangs out there that creates a good deal of uncertainty?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, you've had about 13 minutes to pore over these numbers. What's your big take, sir?
Jonathan, I think the big take here is January is a difficult month. There's a lot of moving parts. This is a mixed report. I think the conclusion remains the same. There's a very strong labor market. It's not going to change the Fed outlook. But probably the most interesting thing is the last thing that you said, that may be what the market is keyed on, which is the annual benchmark revisions. The market having expected a lot bigger validation of the story that the labor market is overstated in terms of payrolls. And the overstatement was not as overstated as people thought, and so maybe that's pushing up a little bit on the rate reaction. But overall, it's a mixed report. AHE, as Mike Collins and you guys highlighted, that's probably flattered by the reduction in the work week. The unemployment rate ticking down, that's on the strong side. And the payroll headline is a little bit disappointing, especially given the seasonal expectation that that would give it a seasonal boost. Overall, I think you talked about in the earlier session about the asymmetry to the Fed. It's going to take a very, very strong report, and unlikely to come out of the labor report, but really an inflation report to push the Fed off of the cutting expectations. Whereas a weakening side, the Fed's going to be very quick to cut. I don't think this changes the outlook. We're still on pause here well through the first half of the year, and a lot more data is going to be necessary for the Fed to accelerate their pace of cutting, because they were very clear in highlighting in the FOMC, they're in no hurry to cut.
Jeff, you talk about the asymmetry in the Fed's reaction function and their propensity to cut rather than hike if there is a weakening rather than some sort of boon. Is there an asymmetry in investors that needs to be rethought? That people really believed that this was an economy that was starting to show weakness, which justified some of the rate cuts that we saw at the end of last year, that maybe that didn't really exist. Maybe that we actually had a much stronger labor market than people had expected, and this is a market that is more susceptible to overheating than some people gave it credence over the past few weeks.
Yeah, that's the change. We had the fear on the labor market late summer, fall last year. That's been replaced by a debate. You started to get into it earlier around, really, are we that tight given how strong these labor markets are? And maybe the Fed doesn't have to move as far, and maybe neutral's a lot higher than we thought it was because of the performance, the strength in the labor markets, the strength in the economy, and the halting progress that we're making on disinflation. That's kind of the summation of the change that has really pushed us away from the Fed is going to push us into recession, the big increases in interest rates, much more towards what I keep saying on this program. The Fed's ignoring the role of financial conditions, an incredible wealth creation coming out of that Mag 7, AI wealth creation, wealth effect that is leading to much looser financial conditions than you would expect given the interest rate structure. And that's really, I think, the issue here, is that financial conditions haven't been transmitting into the real economy as tight of policy as the rate piece. And the Fed, and comparisons to the Taylor rule and interest rates, are just missing the boat here, that in a modern economy, really the post-GFC economy, it's financial conditions through which monetary policy transmits, not so much the interest rate. We're much less interest rate sensitive. We're much more confidence and spending sensitive, and that's driven by financial conditions.
So, Jeff, all of that said, when you put it together, would you fade the rally that we've seen over the past 4 weeks in the 10-year Treasury yield?
Well, you know, it's interesting. You talk about the 10-year Treasury yield rally, and here we're talking about kind of before Fed and Fed policy. And obviously, there's a disconnect here between talking about the rates on the short end, what the Fed is going to control, what the markets are going to react to with respect to the Fed, and what's going on the long end. And what's going on the long end is going to be much more affected by things like term premium, inflation uncertainty and inflation risk premium, and the fiscal policy outlook. So I think that we've gotten to a level of term premium that is normalized part way. You've gotten a lot better in terms of the term premium, and that's raised the attractiveness in terms of the 10-year relative to the 2-year. I think that fading it is not really the outlook right here. I think what you're going to be looking for is the debate around the next policy. You know, a lot of focus on trade and tariffs. We're going to turn that focus into taxes and fiscal, and that's going to weigh a lot on where that 10-year and that term premium settles.
And that's how you dance around a pointed question. Jeff Rosenberg there of BlackRock. Jeff, appreciate it, sir. Thank you very much. Following the payrolls report about 20 minutes ago, downside surprise on the headlines number, but a much hotter than expected wage print. Tease us up for next week. CPI on Wednesday, also on Wednesday. You'll hear from the chairman of the Federal Reserve testifying in front of the House.
That could be more important than the number that we just discredited for the better part of the morning, and that actually is causing people to rethink exactly where we were. If you see an upside surprise, does that become a real move that unwinds some of what we've seen over the past month?
Reaction from the White House first, right here on Bloomberg, just moments away, about 15 minutes away. We'll hear from the National Economic Council Director, Kevin Hassett, so look out for that conversation in just a moment. Before we get there, let's give you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Recapping the payrolls report, the U.S. economy added 143,000 jobs in January. The median average in our survey had been calling for 175,000. Meanwhile, unemployment fell to 4%, and average hourly earnings, they rose 0.2% from a month ago to 0.5%. President Donald Trump has tasked his Vice President, J.D. Vance, with overseeing the future of TikTok in the U.S. Punchbowl reporting Vance will work with National Security Advisor Michael Waltz. On his first day in office, Trump issued an executive order giving TikTok a 75-day extension to find a buyer in the U.S. or face a ban. And the Kansas City Chiefs are looking for their third straight Super Bowl title. The Chiefs will take on the Philadelphia Eagles in Super Bowl 59 on Sunday. President Trump is set to become the first sitting president to attend the game in person. He posted on Truth Social this morning saying, "Two great quarterbacks in this game, also an unbelievable running back, and the absolute best tight end in football ever." He sounds excited. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Sneak peek of next week as well. And we'll count you down to our interview with the National Economic Council Director, Kevin Hassett. Kevin joining us in about 10 minutes' time.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never. Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released.
The equity market is totally unchanged on the S&P 500. Your trading diary for today and into next week looks a little something like this. This afternoon, President Donald Trump meeting with the Japanese Prime Minister. Look out for that on Tuesday. You'll hear from the Fed Chair Jay Powell testifying before the Senate. You'll hear him testifying before the House as well next week. The Wednesday morning will be dominated by the CPI report. On Thursday, another round of jobless claims. And on Friday, a retail sales report. Coming out in about 5 minutes' time, walking out of the White House, you'll see Kevin Hassett, the National Economic Council Director, joining this program first, right here on Bloomberg Surveillance. And I think we've all got the same question, Bremo. What would you ask Kevin Hassett in 5 minutes' time, Torsten Slog?
Well, ask what the view is on the economy going forward, ask on the view on what fiscal policy is going to do and what tariffs might do and what that might mean for the outlook.
And how complicated life might become if we can't get those tax cuts from this Congress.
At a time when a lot of people are baking that into their projections, at the same time, does this administration have more room to take their time if this is an economy with plenty of heat behind it, so it isn't necessarily at risk of cracking?
I like what Chris Verone said at the top of the show. What is the pain threshold for these policies? That 10-year yield that Scott Bessent, he said Donald Trump is so focused on this time around, how high can that get where it's going to push back on all your fiscal policy plans?
You think we'll get a yield target out of Kevin?
Most likely.
525.
525, are you kidding?
525.
You think that that's what he's going to say?
525.
Yeah, all of a sudden, I'm sorry, Kevin Hassett cannot join us. Absolutely not. It'll be 3.5%.
Again, a yield target from Kevin. Kevin Hassett just around the corner.
Zero.
If you're just joining us, the jobs report came out about 25 minutes ago. Came in at 143. That's the headline number. The estimate was 175. Headline number a bit softer than expected, but the details hotter than expected, particularly earnings. Wage growth coming in at 0.5%. The estimate was 0.3. The equity market pretty much unchanged. The opening bell 34 minutes away. Kevin Hassett, the National Economic Council Director, live from the White House, up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world, and so that has been very lucrative as a business.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Live from New York City for our audience worldwide, welcome back to the program. The opening about 30 minutes away. Equity futures on the S&P 500 just about unchanged. On the Nasdaq, a similar move. The jobs report out moments ago. Downside surprise on a headline number 143. The estimate was 175. Wages come in just a little bit hotter at 0.5% against an estimate of 0.3. With some more details, let's cross over to Mike McKee. Morning, Mike.
Good morning, John. Well, as you mentioned, the unemployment rate comes in at 4%, and that's one of the key numbers here. However, it's sort of impossible to tell exactly why it went down because these are based on the change in the population numbers that the BLS incorporated this month. So you sort of have to take it as this is what the revisions to the hiring and firing numbers gave us, and it doesn't tell us much about the direction of the economy or where we'll go from here. One other note, the BLS says there was no impact from the California wildfires or from bad winter weather during the month of January. So those are two dogs that don't bark. Probably the biggest news in this for the markets, average hourly earnings, you can see there up 0.5 percentage point, significantly stronger than anticipated, although weekly hours went down a tick. So there is still some strength in the labor market that feeds into perhaps wages. And we'll keep the Fed at least watching what's going on in terms of the inflationary impact.
Mike McKee, appreciate it, sir. Thank you. Let's extend this conversation. I'm very pleased to say that joining us from the White House is the National Economic Council Director, Kevin Hassett. Kevin, welcome to the program, sir. It's good to catch up with you once again.
Sure. It's great to be back.
I want to say, first of all, Kevin, congratulations on the new seat. You know the NEC has a storied history going back to the 90s, including Bob Rubin and Glenn Hubbard. I know you know all of that. I just want to take a step back, get away from the numbers we've got in front of us just now, and think about the last few years. What kind of labor market are you and the team inheriting?
Oh, you know, I first also want to say thank you. It's great to be back at Bloomberg, and thank you for the congratulations. And you're right. If you look at the people who've been, you know, in the office I am in now, like even Lael Brainerd before, I'm kind of humbled to be there. I also want to say thanks for leading off with Mike McKee. I've been watching him do jobs stuff for like 20 years, and I always want to hear what he has to say. And sure, he had a couple things in there that I hadn't noticed in the release, and so that's great too to be back. I would say that the big headline for me is something that you guys haven't talked about yet, but I'd encourage you to, is that we've got this thing going on where the professionals at the BLS keep revising down the data. And so the headline for me when I'm looking at this is that it was the biggest downward revision. You know, the benchmark goes through last March, the biggest downward revision since 2009. And we're still sifting through the numbers, but, you know, it's really, really big. Could be as much as, if you go a little bit beyond the month, the last month, it could be as much as 1 million jobs fewer than we thought after this benchmark revision. And so the thing is that why is it that we keep seeing sort of positive jobs numbers, and then when we look back a year later, it's way worse than we thought? And so I say that what we learned with all these downward revisions is that the Biden economy, the Biden jobs market, was way worse than markets thought. And that's sort of consistent with the rest of our views that their policies were unwise, and there's a lot of cleaning up to do. And I think that if you look at ISM that just came out, that people, market participants, believe that President Trump is going to be able to turn things around. And with these big downward revisions, we can see that there's actually a lot of work to do.
So, Kevin, that's your opinion on the state of affairs. I want your view on the policy matter. And I want to get a bigger picture view as well, because I think your approach is getting lost in the trade headlines. The fuller approach is getting lost in the trade headlines of the last week or so. Can I ask you how your tax plan might complement the trade effort, how these two things might gel?
Well, it's obviously, you know, President Trump's tax plan working together with congressional leaders. You know, we had the A-team meeting together in the White House yesterday, including meeting with the president and the vice president to talk with the top House members about exactly what they want to see in the reconciliation package and finally the bill. And, you know, in politics, there's always going to be a work in progress. But I can tell you that President Trump has assembled the very best possible team to negotiate with Congress and make sure that they can be successful. And you've seen some of the news from that. And I think the headline news is the president has stated, as he always does, exactly what he wants. And that's not like just negotiation, that's what he wants. And the people in the House were able to work with it, and now it looks like there's a lot of positive momentum after they met with the president.
So, Kevin, just going through the list of things that the president wants, and of course you know them well, but for the benefit of our audience that might just be joining us.
Sure.
Ending taxes on tips and overtime, new cuts for Made in America products, extend TCJA from 2017, expand the state and local tax deduction. There's a lot there. One of the offsets was to end the carried interest loophole, which was a little bit of a surprise. There's another offset as well, potentially in the mix. And this is where the trade story fits in. And I'd love your view on things, Kevin. What is the objective of the trade approach? Because in the first term, it was about reciprocity. And the administration at the time, and Larry Kudlow was in your position, made a pretty forceful argument to say, we're doing X and China's not following up. They need to do more. That all made sense. Now it's about national security, the southern border. It's about drugs. It's about potential revenue raising as well. Which one is it, Kevin? Can it be all of the above?
Oh, you know, the bottom line is the first time I ever met the president, right at the beginning of 2017, that one of our first discussions about trade policy was about reciprocity. And so 100%, that's going to be a key factor in President Trump's thinking and his team's workouts from his thinking as we work forward. And when you think about, well, what is reciprocity? How should we think about it? Then a lot of people focus on tariffs, tariffs, tariffs. And if we look at just tariffs, then you'll see that our trading partners tend to have tariffs that are 2 or 3 times higher than our tariffs. And so, like, if we were going to be reciprocal, then they could come down or we could go up, but it would be a lot different trade policy. But the way I like to think about it is just think about the fact that we have a tax system in the U.S. that's fundamentally different than the tax systems everywhere else in the world. And so I had my guys a couple days ago just update the numbers I always look at, and we found that U.S. multinationals had paid foreign governments $370 billion in taxes because of value-added taxes and income taxes in 2023. And foreign multinationals operating in the U.S. paid the U.S. government only $57 billion in taxes. And so they have 3 times the GDP we do, you know, globally. We're about a quarter of GDP. And we're paying $370 billion, and they're paying $57 billion. And that's not reciprocal. That's something fundamentally different. And what President Trump wants us to do is to come up with a really smart program that includes trade policy, tariffs, and revisions to the tax code. And he wants us to make it work so that America's on a level playing field again. And the reason he wants to do that is not because of the numbers, it's because of the people. The people in America who don't have jobs because we're paying $370 billion a year in taxes to foreign governments in order to incent our companies to not create jobs here, but create jobs overseas.
Kevin, you didn't mention Europe,
to the president.
but it sounds like you're talking about Europe. What's the ask of the Europeans?
The president is going to negotiate with the Europeans. He's going to negotiate with everybody. And at the time when he does that, you'll find out what his asks are specifically.
Are some situations more negotiable than others? We've seen already you put the threat on the likes of Canada and Mexico. Mexico provided some concessions. We saw the same thing from Colombia. Is the approach to Europe going to be any different?
I mean, 100% what happened over the last week wasn't a trade war. Why would you have a trade war with your neighbors that you trade with so much? It was a drug war because 90,000 people died of fentanyl because of the fentanyl coming across the borders in Canada and in Mexico. A lot of times the drug from Canada was coming across from the Mexican drug cartels, by the way. And so the Canadians and the Mexicans made a deal with us to make progress on this, because it's absolutely unacceptable that more people die from that poison than from the Vietnam War in 1 year. And so we just had, a discussion about how are we going to win the drug war, and that's what happened then. I'm not aware of, nor have I been informed of, massive fentanyl shipments from Europe. And so the discussions we have with Europe will be about other things.
So it sounds like you want to do revenue raising on more tariffs, potentially when it comes to Europe. Does that need to happen before the tax bill, or is the president willing to expand the deficit, Kevin?
The president is negotiating the parameters of the tax bill as we speak with members of Congress, and he's asked the Treasury Secretary and me, the Director of the National Economic Council, to meet regularly with leaders of the House and the Senate and to see what's possible and what's right and good and should happen, and to get them as close to exactly the same thing as possible. And that's what we're going to do. It's
Kevin, as you
my
know,
vow to you guys.
Republicans in Congress are not on the same page. He spent a lot of time with members of Congress yesterday, but he's going to have dinner this evening with senators. Do you have a sense of what the president prefers at this moment, one or two bills, when it comes to Congress enacting his legislative agenda?
The president is going to work that out with them, and he's talking to everybody. I know that there are different opinions on the Hill, and we'll see what happens.
You also know, Kevin, that confidence coming into 2025 from corporate America is sky high. Sentiment is really robust and strong. You know that. The president does. We all know that here on Wall Street. Is there a risk that you squander that confidence? That confidence doesn't translate into action, into hiring, into CapEx, without clarity on a trade story?
I think that we're a couple weeks in, and we've made an enormous amount of progress. And everywhere I look, people are saying, how could you guys possibly get so much done in such little time? And the thing that I can promise markets and you guys, and you'll probably be back next week with you to talk about more things, that this pace of progress is not going to slow. It's not going to slow at all.
Kevin, stay in touch. Looking forward to covering the next 4 years with you. Thank you, sir. Appreciate your time.
Say hi to Mike.
I will do. Kevin Hassett there, the National Economic Council Director, on the latest jobs report, and a little bit of an outlook there on the policy changes you might expect from the incoming administration, the new administration under the President, Donald Trump. Torsten Slock of Apollo is still with us around the table. Torsten, just wanted some thoughts from you about what you heard there and what you're expecting going forward from here.
Well, I think a very important point that Kevin made is, of course, this issue that the trade war, of course, we went through the last week. There are some chances that this could continue. But as Anne-Marie was saying, if this uncertainty hangs over the business sector, if this uncertainty hangs over financial markets, it could potentially be something that could have some implications, especially if we don't get clarity over some time horizon. So I think that, very importantly, there's a number of things going on the tax front, there's a number of things going on the tariff front and trade front, but we still need to see more details in terms of the specifics, in particular on the tax front, and what the implications are for the outlook.
I got more clarity from that conversation about tariffs. Our trading partners tend to have tariffs that are 2 or 3 times higher. He's talking about Europe. What are you expecting when it comes to the EU?
Well, he has said that he absolutely wants to impose tariffs on Europe, so that's probably why Europeans are probably a bit worried at the moment about that they might go through either something similar to what we did here over the weekend, or they might be going through something that's a lot worse. So if something is coming in one form or another, then a good guess is that the Europeans are probably somewhat anxious about this situation where they have been pointed out already as someone who is maybe next in line.
Do you think tariffs on Europe, tariffs on China are enough to quell the bond market in terms of the pay-fors for this massive tax bill that the president added to that list last night?
Well, if you look at some of the simulations from the Committee for Responsible Federal Budget, from the Tax Foundation, from the Peterson Institute, also from Cato, they do show that the drag on GDP growth of a trade war could be as much as 0.5%, and it could be boosting inflation by as much as 0.5%. So in terms of tax revenue, of course, there are still a lot of things that remain unclear in terms of what will the overall tariff implementation look like across countries. But given some of these things we're talking about, the extension of the TCJA is poised to cost about $5 trillion. None of the estimates are pointing in the direction of being enough to pay for that.
Torsten, they want non-inflationary growth. That's difficult to achieve. The former president achieved that with a liberal, some might say reckless immigration policy. How achievable is it for this administration, and how likely is it we'll be talking about your rate hikes pretty soon?
Well, one challenge is that deglobalization is almost by definition inflationary, because that means that we have tariffs, which is by definition, of course, putting restrictions on goods coming from the outside, and deglobalization also on labor. It's also meaning that we have restrictions even on labor coming into the economy. So that means that by definition, combined with tax cuts, all that means that restrictions on immigration, also higher tariffs, and lower corporate taxes for domestic manufacturers, which is talked about to lower to 15%, that would all be putting some upward risk to inflation.
Torsten Slok of Apollo, with still, I would say, a contrarian view on interest rate hikes later this year. We'll see how popular that view becomes in the months to come. Torsten, appreciate it, sir. Up next on Bloomberg TV, Open Interest, Manus Cranny and Vonnie Quinn will guide you towards the opening bell. The opening bell about 17 minutes away. Equity futures at the moment just about positive on the S&P 500. Coming up on Monday after the weekend, we'll be catching up with Marvin Lowe of State Street, Victoria Fernandez of Crossmark, Liz Ann Saunders of Charles Schwab, and Jonathan Pingle of UPS. Look out for that on Monday. For those of you joining us this morning, good morning to you all. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Less than 15 minutes until the start of the trading day. Welcome to Bloomberg Open Interest. I'm Menace Cranny.
And I'm Bonnie Quinn. Matt Miller, Katie Greifeld and Shonali Basak are off.
Let's take a look at how these markets are trading post the non-farm payrolls, Bonnie. I think we've got what you call a sort of reasonably Goldilocks number. Wages firmer than expected, plus 0.5%, the unemployment rate dropping. So you have got this fully bolstered equity position, NASDAQ 21,866, but the yields pop a little bit at the longer end. Bank of America says the rest of the world is front-running. Peak U.S. exceptionalism. We'll discuss that in just a moment.
It's really the perfect time to be talking to Rick Reeder, which we will do in a moment, because as you say, the big move is in the bond market, and you have to ask the question, what does this jobs number signify for risk and how much risk this market is willing to take, whether it be on Federal Reserve moves or on the strength of the economy?
Well, look, we've popped back up there by 5 basis points, 449. The interesting thing here is the 5 days that we've traded this week, we were down 10 basis points into that unemployment number, and yields were dropping for 4 weeks in a row. This set of data probably lays the table really for the justification of the pause and the cautiousness we've heard from the Fed.
It's the perfect time to bring in our first guest this morning, BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder, who joins us now. So, Rick, before we get to Kevin Hassett's comments and some of the details of the jobs report, what do you make of the market reaction where we're seeing very, very slightly positive futures and into the equity open, perhaps, but a big jump, really, in yields?
Yeah, so I mean, listen, I think when you parse through, this is interesting. Is the headline hit and you got the weaker headline, 143,000 market for 30 seconds rallied, and then actually dig into it, and you see that the unemployment rate came down, average hourly earnings were up, and then you go deeper and you look at, gosh, for the 3-month moving average of jobs hired is 237,000. That's up from 178,000 over 6 months. So when you put it all together, it's like, boy, it's hard to debate that you've got a solid employment report. You know, there's some other indicators and jolts and otherwise that show maybe some modest softening, but boy, you got to look really closely to see it. You got a solid jobs market, and I think rates market has, like you said, has rallied a bit, interpreting that maybe the Fed can get these cuts in. But listen, I don't think the Fed's going to get cut anytime soon. You got labor in a good spot, you got inflation that's far from target and not really decelerating. So I think what the market's telling you is we're on hold at the Fed for an extended period of time, right? And so that backup after a pretty good rally, you know, markets are rightfully backing up in the rate space.
Rick, good morning to you. Good to see you. So this gives the Fed a beautiful air cover to deliver the caution, to hold on to the cautious narrative. I want to dig deeper into the 40 basis point drop since the middle of February, down for 4 weeks in a row. Why?
So I'd say there's a couple things at play. One, you know, the world was worried about big tariffs coming in, big across the board. I still think you're going to see across the board tariffs, maybe not as potent. So there was a little bit of easing off of that. Secondly, I think one thing that, first of all, I think a lot of people got short, and you saw this in all the indicators we saw in the technicals, that there were some short positions that had to be covered. And then, listen, at the end of the day, there's something that we haven't seen in a generation, the amount of cash that's out there and the amount of money. If you see this in the equity market, you see this in the bond market. Without a catalyzing piece of news that suggests, gosh, we need to reduce some risk or interest rate risk, you see a market. By the way, you saw in the equity market for those 2 Mondays where you saw some pretty potent downturn. And then, you know, as things move on, that cash starts to make its way in. We're seeing it in flows around, particularly in income, that people are putting money to work, and it's just a market flush. I mean, the system is flush with money, and then if you don't get anything that suggests taking money out or being cautious, I think you see markets gravitate higher.
Rick, can I ask you something? The NEC Director, Kevin Hassett, just told the surveillance crew, he said that downward revisions perhaps are worse than it seems. He said there could be as many as 1 million fewer jobs than we think. We got a, downward revision that was not as bad, if you like, quote unquote, as some were expecting. Is there any truth to the statement that there is possibly, a worse jobs market out there than the data is showing today?
Listen, the revision data that he pointed to is right, and so you are revising down, but you're revising down some numbers that were pretty good. When you look at this 3-month, 6-month, 12-month moving averages, boy, it's pretty hard to say the jobs market is not solid. And you look at the last couple of months in these revisions. So
yes, I get the point about, gosh, was it as strong when you go through those prior revisions? Maybe not, but I have to say, when you look at this report, it suggests to me the market's just including where we are in earnings. The job market is maybe I learned today maybe a little bit tighter. So I still think it's a good job market. The critical thing I think for the next 2-3 months, let's keep an eye on immigration. What happens to the size of the labor pool? What happens in the delta on how many people are deported, et cetera? So that's going to be critical. But gosh, I think you'd have to be a skeptic to suggest that the labor market isn't in pretty solid shape.
As you say, the first part of this administration has been all about the tariff stick, the noise around that, and perhaps less around the immigration piece, and that is the supply disruption that this bond market is perhaps not pricing in at the moment, Rick. So I presume you're not a stagflationist then. You sit in a different camp.
Yeah, so first of all, by the way, I was in Europe all week, and every meeting you go into and every client discussion you have, we start, and then the first 15 minutes are let's talk about tariffs and let's talk about, what this policy is going to be. Listen, I think you'll see some across-the-board tariffs. You'll see some bilateral negotiation, but I actually think you got to get across-the-board tariffs because we've got a revenue problem in the country. You need to create that revenue to offset some of the other, as well as spending cuts to offset what are the tax cuts, et cetera. So, listen, I think, and I've been on this show with y'all for a long time, and you think about last year, we had two bouts of people saying recession's on its way, get ready. U.S. economy is extraordinarily resilient, and if you look at the data the last 2-3 months, and you look at, and now you take some animal spirits that are in the market, or when I say in the market, in the economy, you get some deregulation. There's a potential for significant offset. I agree with the point around deglobalization. What does that do? And is there a higher price point initially? Boy, I think there's this dynamic around where the economy is. To run 5% nominal GDP is pretty impressive, and to run it as persistently as you are. And then when you break it down and say, gosh, where are we? Consumer and corporate. Consumer is in very good shape. You have a 4% unemployment rate and income levels that are good. And then corporate CapEx, particularly around AI, particularly around the R&D spend. You're seeing software, cloud. I mean, it's interesting, these earnings reports people are disappointed by. Why were they disappointed by it? So there's not enough capacity. And so, listen, I think the economy, not to be too much of an economic bull,
yes.
but yeah, I think the economy is in pretty good shape.
So then your reaction, Rick, to Scott Bessent, the Treasury Secretary, saying, that they want to keep the 10-year in particular, but the whole curve a little lower. Is that possible given the, the outlines of the plan that have been laid out?
So I think it's possible. Listen, I don't think rates are going very far. I think it is possible, but I think one of the things, over time, we've got to figure out how do we manage the debt. I think what Scott's talked about, we got to extend the term structure of the debt. We issue a tremendous amount of bills every week. We've got to start to manage that debt burden. We've got to manage the amount of auctions that we are going to have in this country. And then, listen, if people are confident in that inflation will come down over time, there's some things that could happen that people don't talk about around productivity. The backside of AI, the backside of technological evolution is productivity enhancement. Productivity enhancement, robotics, automation, use of software and efficiencies, inventory management, logistics. You have to believe that you can see some inflation, and particularly if we do get energy costs down, then you could start to see some improvement in inflation. Listen, we can see it in the next month or two. We got CPI next week. We think that's going to be a firm number. But I think as you get to later in the year, you'll start to see some productivity work its way in the system, and then then you can keep rates around here.
Okay, building the bullish case. Rick, thank you very much for Rick Reader of BlackRock on the bond market, and you can follow along with all the latest jobs analysis. We have a T Live on your Bloomberg terminal. Quick snapshot of what's going on in these markets, Vonnie, on the back of that. Just noticing the curve steepening a little bit. Obviously, the long end, the duration is popping a little bit higher. It's coming in less than 4 minutes to the opening bell, so we'll take you through that in just a moment. S&P 500, 6109.5, flat on the day.
in this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing world
India-centric,
countries.
now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but is producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
New up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
We're moments away from the start of your cash trading day. It is Bloomberg Open Interest. I'm Manish Cranny. Let's just show you how these equity markets are at the moment. Stoic with, a fairly robust jobs report. Wages are up. Unemployment is down. Yes, the headline number missed ever so slightly. But the S&P 500 is flat going into this. The NASDAQ, we'll pick up the story on Amazon in just a moment. It's about the flow. $600 million left the U.S. equity markets through to the 5th of February, according to Bank of America's flow show. There you go. Good ringing the bell at the NASDAQ. We're just waiting for these equity cash markets to open. So it is about the flow in terms of that excellence of the U.S., that uniqueness of the U.S. relative to the rest of the world. And this is what Bank of America say. Global dominance may be challenged. Cash market is open, 60.84, 21.780. We'll talk through the tech narrative in just a moment. There are some individual names that we're going to keep a close eye on through the day. Firm shares, up 11.3%, surging after swinging to a profit in the last quarter and giving a nice strong outlook for the full year sales growth. A number of analysts are actually raising the price targets on the company following the earnings call. Bonnie.
Well, Manas, we have a different story when it comes to e.l.f. Beauty, the low-price cosmetics giant, seeing a slowdown in demand for January, and that prompted it to soften its outlook, but that could spell trouble for the full-year growth for 2026, or at least expectations for that. We'll be talking to the CFO in just a little bit, so that's e.l.f. down 26%, losing a quarter of its market cap already today. Skechers also issued annual forecasts for sales and profit that trailed Wall Street expectations. Pinterest, though, well, there's a better story there. It posted strong holiday quarter revenue and gave an upbeat forecast for sales in the current period. Now, Amazon, well, we know it warned investors it's struggling to keep up with capacity for AI demand. And this in spite of plans to invest $100 billion into data centers and homegrown chips and more this year. CEO Andy Jassy says growth will be lumpy as he deals with constraints in hardware and electricity. The stock right now down 2.6%. But let's take a closer look at these Amazon results with Bloomberg Technology co-host Carolyn Hyde. So for Amazon, Carolyn, what is the biggest concern? Is it access to NVIDIA chips, developing its homegrown chips, capacity?
Power, chips. This is what Andy Jassy said, as thus far perhaps curtailed the meeting the extraordinary demand that we're seeing for their compute. This is the moment for AWS. This is where, with their dominant force in terms of cloud computing, they should be winning client after client. They're offering you an entire vertical stack of AI. They've got the chips that they, of course, have their own as well as NVIDIA's. They can offer you large language models, their own, as well as, maybe a DeepSeek model, should you wish. They're also offering you the compute that you can use, and it's going out to business after business, the startups and the big caps. But
this does take money. $100 billion worth is what they're going to invest this year. They're already cranked up $26 billion of spending in their fiscal fourth quarter, but that is the run rate you have to see to have them match that sort of level of demand, Manus.
I mean, if you look at what's expected to be spent this year, Caroline, $280 billion. So there's no stepping back, even after DeepSeek, but they've all got capacity constraint. Amazon, Microsoft, Alphabet. You know, the question is, how quickly can they fill that gap?
And I think there is so much optimism today. I know the shares don't reflect that, and they're down about 2%, but analyst after analyst is re-rating this stock. The price target higher. We've got the only single sell rating on this stock has
Who's
capitulated. Morningstar have now brought it to a hold, so they've got 0 sell ratings, 79 buys, and the price targets by Wells Fargo, whether you're seeing over at Morgan Stanley, whether you're seeing it at every single name, is re-rating the price target higher. This is jam tomorrow, not today. They are reinvesting.
And the thing is, we have to remember that, right? Because we've seen that with many of these names. They've had a run up into earnings.
Yeah.
Microsoft, a 30% run up.
So right.
And so they sell off just a little bit, maybe on earnings, but 2.6%, it can be, it can be a little profit taking. Will these companies, though, end up paying for this huge amount of capex? I mean, we've something like $300 billion between 4 or 5 companies promised for this year, $500 billion promised for the next 3 to 4 years.
Bloomberg Intelligence, the credit analysts over there, saying, I like the use of phrase de minimis, considering de minimis is where we're all thinking about the competition from China, but they're saying de minimis impact in terms of credit rating when you're thinking about the amount that they're spending. These companies are cash rich. They've got so much money that they can be investing. Sure, it means that the operating profit that comes in at more than 60% for the fiscal fourth quarter gets pulled back a little bit. But really, you're still getting profit handed to you. You're still getting revenue growth of in excess of 9%, potentially 8% for the next fiscal quarter. And they are still able to re-evaluate and reinvest. So yeah, you're right. There is a question of the Herculean amount of money that's going in. But of all the companies out there, these are the ones that can spend it.
Well, I tell you what, take a look at Meta. It's up for the 15th day in a row. I mean, it's just blasting through. It's like one thing after another. Caroline, we'll see you a little bit later on. Caroline Hyde there with the very latest on the technology story. Let's begin the investment story with the BMO Wealth Management, Investment Management Officer, Young Yu Ma. Young Yu, great to have you with us this morning. We've got the jobs report. Wages are hot. Unemployment is low. The tech companies are all preparing to spend more. How embracing of risk are you right now, given everything that's been thrown at this market since President Trump took to power?
Thanks, man. It's great to be here. Yes, we are embracing of risk here. We do think the market has shown quite amazing resiliency, and we think some of these trends that are taking place, such as you see today with Amazon spending, other mid-cap tech companies spending, that's really going to have a significant impact on the economy, as will AI rollout and productivity trends this year. So we think the underlying backdrop is quite favorable, but we do, of course, recognize that disruptions can happen at any time from tariffs, and there could be volatility along the way, but we think the economy and the markets can withstand that.
What is the primary concern of your clients right now? Is it, that the AI, I don't want to say bubble, but the AI enthusiasm might be starting to fade? Is it something about the Fed or the new administration?
I think the primary concern still probably revolves around tariffs. That's both from the business standpoint and the consumer standpoint, and the uncertainty that creates. Businesses not knowing where they should be investing, when they should be investing, how aggressively they should be investing, and consumers worried about will there be another price spike that takes place. So I think the biggest issue with tariffs is probably the uncertainty issue, maybe even more so than the actual results that play out or implications from tariffs that might come to be. The uncertainty that is created right now is probably going to lead to a bit of a pause, both by consumers and corporations, until this gets resolved.
With that in mind, though, what we've seen in the bond market right now is coming down in terms of yield. We just finished a conversation with Rick Reeder there. We're down for 4 weeks in a row. We've given a little bit back this morning on the back of the strong jobs report. How important is that dissipation in yield to pick up duration stocks?
Well, I think long-term yields staying around the levels where they are now, being relatively stable, is helpful to the markets. We don't want long-term yields running away to the upside. We don't think they will. We think the forces that would push yields up versus those that would push long-term yields down are relatively balanced here. But we do think that's an important key metric right here that we're looking at that indicates whether or not the market can remain stable or whether or not we see too much of a push to the upside, which might pressure those longer duration stocks. We don't think it's going to happen. We don't see the labor market pressures accelerating, even despite some of today's numbers. And we actually think that some of the softness that might take place in the labor market could come forward or could come forth in the coming months. So we think we're in a good spot here, actually, with respect to yields.
Is it a time to stay in the risky assets that we've seen doing well, the Magnificent Seven, you know, perhaps some crypto-related stocks and so forth, or is it time to rotate, Young-Yu?
Well, we do think the market's going to be a bit more discerning here. Certainly the mega cap names have such a strong high weighting in the index that it's hard not to be invested in them with any sort of index tracking that someone has. But in terms of what some of the recent developments in news have signaled, I do think we're in a phase where we're shifting to more of a software focus away from a hardware focus. The good news is that you do see the spending being continuing to be robust, and these mega cap tech companies really accelerating their hardware spending. So we don't think that's going to let up a lot, but we think a lot is priced in there. And really the next wave are some of the applications that consumers and companies start to use and roll out to gain efficiency. So we think there's a shift that's taking place underneath the hood there, and that's something that investors should be aware of.
And that's the shift from, you know, enablers to adapters, and therein lies the productivity conundrum. Do you think that that productivity uplift comes as soon as this year, and what is the consequence for that in terms of investment?
Yeah, we absolutely think it's going to come this year. It's already started quite robustly in terms of anecdotes, and the next stage is going into the data and the numbers and the profitability that companies see. That might be a couple quarters out before those numbers are obvious and strongly apparent, but we do think that's underway right now and will be more underway throughout the rest of the year. The implications for investors is I think that's one reason to be optimistic here. And even if we get volatility, even if we get tariff news that's disruptive or might give the market higher uncertainty for a month or two, those underpinnings that support profitability, that support growth, and that support corporate health are still there. What does it mean for the labor market, though? The labor market is probably going to be relatively muted despite this growth. So we're not going to get the inflationary pressures, but we're also not going to get aggressive hiring as companies grow.
Young-Yu, thank you so much for joining us today. That is BMO Wealth's Young-Yu Ma. Coming up, the shine seems to be coming off e.l.f. Beauty as it lowers sales guidance. We'll discuss what's next for the cosmetics company. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Time now for our top calls, some of the analysts to action in focus this morning. We begin with Citi downgrading Nike to a neutral. That analyst says that 2026 is not shaping up as an inflection year, and he doesn't have the, quote, patience or conviction to wait another year. He's just not doing it. Next up, Deutsche Bank is upgrading Honeywell to a buy. The conglomerate announced yesterday, obviously, that it's going to split into 3 separate companies, following pressure from at least one activist investor most recently. And finally, Morgan Stanley cutting its rating on e.l.f. Beauty to a neutral after the company lowered its sales and profit outlook. The analyst says e.l.f.'s small size and volatile track record increases risk, and that company is losing a quarter of its market value right now. It is a terribly volatile stock, but today it's a particularly tough time for e.l.f. Eyes, Lips, Face. Let's discuss the company now, though, and its outlook with Bloomberg Intelligence senior consumer analyst Lindsay Dutch. Lindsay, it's interesting because Morgan Stanley came out and made these comments. Obviously, the market is not taking the softening outlook and the soft January well, but Piper Sandler says it's struggling not to come up with a scenario where things go well for e.l.f., that the math just doesn't add up, even e.l.f.'s own math.
Yeah, so I can understand that. So the company, they have grown sales at a tremendous rate over the past 2 years. They're continuing to gain market share. Even the third quarter, the top line beat, and they grew by 31%. Their guidance, they cut the annual guide. It was only a slight cut, but the big concern is this is a brand that has bucked the broader trend for over a year now. And so there's concern that this popular brand is now going to be feeling this softer beauty demand. But if you dig in, what they're implying for the fourth quarter, down 1% to plus 2% growth, that's a massive deceleration from 31% growth in the third quarter and 77% last year. So I can understand, thinking about those pieces, is there a possibility that the fourth quarter is better than they're expecting?
So, Lindsay, good morning to you. We're going to speak to the team from e.l.f. in just under an hour. The risk here is that they then spiral into an inventory build-up. They have to cut prices. They're one of the major brands out there on the shop floors here in the United States of America. What are they going to say to the market to convince them that they can put a floor under this?
So I don't think that they are going to cut prices. I don't think that would be how they sort of manage, reigniting demand for their brand. They are very big on social media. They have a very strong Gen Z following, and they have really pushed on that marketing lever for the past 3 years now, and it has worked for them. And so I think they will try to really lean into that marketing and try to get the brand back to being that viral sensation that it has been over the past 2 years. I would also say the guide, is based on soft demand in January. And and they're assuming that that trend persists through the rest of the fiscal quarter. There is a possibility for some strength in February, with Valentine's Day, with people going out. There is opportunity for that demand to come back and come back fairly quickly.
Yes, we need that lip oil for Valentine's Day, that's for sure. The average price product on an ELF product is $6.50, Lindsay, and that's partially because 80% of its supply chain is located in China. Will that change if tariffs go on and stay on?
Yes, so they are the master of the dupe. They are offering low price products that do very similar things that very expensive product will do. They had actually raised their prices a couple of times, one of which they raised almost all of the SKUs about 2 years ago, sort of to combat, the higher costs that they were dealing with, with their supply chain in China. I think, a big concern with, raised tariffs, their costs are going to go up again, and their first lever would be to actually increase their prices. They have a big enough gap, with that average $6 price versus a higher price brand. But that move gets a lot harder to execute if demand is weakening. So I think, we're at a crossroads here, if raising prices is the move to preserve margin, but demand isn't great, they might have to come up with something else. But diversification would be really difficult to do at a very rapid pace.
Well, we're going to be asking the CFO in just a few minutes. Thank you, Lindsay Dutch of Bloomberg Intelligence, for all of that context. That stock down about 21% now. And coming up in the next hour, as I'm saying this, we are going to be speaking with the CFO of ELF Beauty. That's at 10:30 Eastern, right here on Open Interest. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
It's Bloomberg Open Interest. Quick check on these markets on Jobs Day. You saw wages come in hot, unemployment dropped to 4%, up a little bit on the S&P 500 at the moment as yields roll low, as the yield market shifts ever so slightly. So this is about the strength in the employment market, despite a little bit lower on the headline jobs number for the moment. As you can see, the Nasdaq up 0.3%. Well, President Trump is taking aim at carried interest, the loophole. It's a favorite tax perk for private equity firms. And that is the topic of today's Wall Street Beat. Alison McNeely joins us around the desk. Good morning, good to see you. Look, for as long as I've ever been involved or Wall Street has ever been alive, people have been talking about taking away carried interest. Why is it that the president thinks that now is the political moment where that actually can work? Is it a real threat?
I mean, it's been a political football, as you've noted, for a long time. Both Democratic and Republican presidents have tried to sort of end this tax perk. It's important to keep in mind that President Trump sort of rode a wave of populism and anger about the cost of living in the United States, and really kind of bringing this topic back to the forefront. Something that is very unpopular with a lot of voters is sort of a way to kind of say, hey, I hear you, here's an idea of how we could make things a bit more equal.
It's so granular, though, that you would think the average voter wouldn't possibly dive into the details of carried interest and what it means and how people get compensated and why it's important, because that's, you know, how you raise revenues and so on. It was key, though, during his 2016 campaign. He didn't really mention it this time around, did he?
Exactly. He tried to do this previously, and ultimately, after fierce lobbying on behalf of the private equity industry, you know, they kind of backed off of this, and it didn't make it into sort of the tax changes last time. The private equity industry really says, you know, the carried interest tax break is an important sort of incentive for the way the industry operates. You know, these firms, these investors take a lot of risk and invest in companies that create jobs, and in order to be sort of fairly compensated for taking that risk, they should get preferential tax treatment.
So wouldn't somebody like J.D. Vance be, you know, not behind this? I mean, he is for small business creation and for, you know, helping the little guys, and he came from that background.
I mean, I can't speak to what J.D. Vance might think about this, but, you know, you raise a really interesting point that there are sort of people in different sectors of the Republican Party and the Democratic Party that feel differently about this issue, whether, you know, they're maybe more on the populist side or less so, and it'll be interesting to see how this plays out.
This comes down to the weight of income, the income split between your basic income, your bonus, but also carried interest for a lot of these private equity firms. Just give us a sense of the tilt and the shift towards you know, that part of the remuneration over the past couple of years.
Right. So at the biggest publicly traded private equity firms, so your KKRs, your Carlyles, your Apollos, we've seen those firms really change the way that they pay their senior deal professionals to orient their pay more towards carried interest, you know, taking home their share of profits from deals and less away from the management fee stream. And by doing that, they're able to leave the management fees for public shareholders. You know, as publicly traded companies, they're very concerned about, you know, making sure those numbers are trending in the right direction, helps the stock price, makes their shareholders happy.
He also separately wants to end the special tax breaks for billionaire sports owners, which is another demographic I would have thought he would want to keep on his side and want to keep happy. But obviously, the amount of money he's going to raise, it's all going to be worth it. Is that what the case is?
I mean, that's a great question, and I think we'll have to see how that plays out. But it is, you are right. There is sort of a tension there at play between sort of where he has gotten his support and some of these measures, and whether or not they'll make, you know, people happy.
Yeah. All right. Well, we'll see in the next few weeks. Alison McNeely, thank you so much for keeping us up to date on all of this. Coming up in the next hour, we're joined by the CEO of FICO. This as more and more Americans adopt buy now, pay later. Plus, the CFO of e.l.f. Beauty joins the show. Let's take a quick look at how markets are faring now that we are 25 minutes into this trade. We're seeing a nice little rally on our hands. Crypto-related stocks are doing extraordinarily well as that currency, cryptocurrencies, Bitcoin in particular, just tops $100,000 a coin now. But the S&P 500, as you can see, up 0.25%. The NASDAQ 100 up 0.3%. Small to medium-sized businesses doing a little less well, but still in the green. The Russell 2000 up 0.1%. And that 10-year yield staying higher by more than 5 basis points after the jobs report came in. Perhaps a touch lighter than expected, but the unemployment rate went down and average hourly earnings were also up 0.5%. So a Goldilocks to good jobs report. Stay with us here on Open Interest. This is Bloomberg.
offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
Breaking news from New York, where Governor Kathy Hochul says 7 cases of bird flu have been detected at markets in 3 of the city's 5 boroughs.
We're issuing a notice and order to temporarily shut down all live bird markets in New York City, as well as in Westchester, Nassau, and Suffolk counties.
As a safeguard, Hochul says,
for a week-long period, no poultry can be delivered to those live bird markets. Each uninfected market must sell down all inventory, undergo thorough cleaning and disinfection, and then remain closed for at least 5 days.
Hochul says there is no immediate threat to public health. Bird flu outbreaks have decimated poultry farms, sending egg prices skyrocketing. A federal judge in Boston is holding a hearing this hour, considering a request from 19 state attorneys general to block President Trump's executive order banning birthright citizenship for children born to parents who are in the U.S. illegally.
Newborn babies are not criminals.
Massachusetts Attorney General Andrea Joy Campbell is among those asking the judge to take immediate action to block President Trump's order from taking effect.
Newborn babies and children should never be political targets, and we will not allow the president to treat them as such.
She said birthright citizenship is a century-old promise made to American-born babies.
Correspondent Cammie McCormick. A federal judge has put the administration's buyout plan for millions of government workers on hold over potential legal issues. CBS's Weijia Zhang.
The White House had a different interpretation, saying it welcomed the extension while blasting remote workers.
If they don't want to show up to the office, if they want to rip the American people off, they're welcome to take this buyout.
Spokeswoman Caroline Levitt. The pace of hiring slowed down in January. Employers added just 143,000 jobs compared to 300,000 the month before. Business analyst Jill Schlesinger.
This report is consistent with the Federal Reserve having the ability to pause its rate cuts. And the reason is The economy continues to function and create jobs despite interest rates being higher than many borrowers would like.
A severe winter storm is blasting its way across the country. A suspected tornado in eastern Tennessee is blamed for the deaths of a mother and daughter at their home in Morgan County. Another twister confirmed along the Hart and Laurel County line in Kentucky. This woman felt yet another in Owsley County, southeast of Lexington.
It's actually dented on the roof where my back and head stuff hit the top of it. It was bad. It kind of like dribbled me like a basketball.
The Dow is up 86 points. This is CBS News. Looking for tips on a Super Bowl bet? Ask the animals.
Zoos across the country have had animals choose the Super Bowl winner. At the Honolulu Zoo, workers put watermelons with the Chiefs and Eagles logos on them in front of Vigai the elephant.
Looks like the Chiefs, come on!
She started toward the Chiefs, but then went with the Eagles. Willie the grizzly bear had 2 boxes of tasty food to choose from at Zoo Montana in Billings.
We'll see. He doesn't touch the eagle yet. There it is.
But fear not, Chiefs fans. Bubbles the hippo at the Fort Worth Zoo and Misha the tiger at the Blank Park Zoo in Des Moines chose your team. Michael Wallace, CBS News.
Wealthy homeowners in the Hamptons worried about losing their gardeners, housekeepers, nannies, and ice raids have gotten assurances from local officials it won't happen. Village and town leaders held a meeting telling people they're all safe. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live. Alex Steele, Paul Sweeney live with you here today. Lots of data today. We had the jobs data earlier this morning. We'll get to that. UMich data just came out with some numbers. A little bit disappointing. We'll break that down as well. We're also going to go down to Louisiana, New Orleans. They're having a little football game down there. Emmitt Smith, former Dallas Cowboy Hall of Famer. He's going to be joining us there from Radio Row. Alex is all fired up. Tons of football questions coming that way.
Sports.
Lindsay Piegza, chief economist at Stifel. We'll get her thoughts on the economic data. Zach Wasserman, chief financial officer at Huntington National Bank. I love talking to this guy because he's just Middle America, give you a really good sense of what his corporate and personal borrowers are. What are they doing out there in Middle America? So that's always a good conversation. But right now, let's go to Joanne Su, University of Michigan Surveys of Consumer Director. Let's talk about this UMich data, Joanne. A little bit weaker than expected on the surface. What can you tell us?
So it came in a little bit weaker. It declined from last month, but it was actually a very pervasive drop. We saw it across all demographic groups. Republicans, independents, Democrats alike all declined from last month. And very much so, this is a worry about inflation coming back in the year ahead.
Yeah, speaking of that, I mean, that one-year inflation expectation ticking up to 4.3%. That's 100 basis points higher than what was estimated and the prior read. That seems very significant. Can you walk us through that?
Absolutely. So this is a huge jump. We very rarely see such a huge 1 month jump in year ahead inflation expectations. So overall, consumers are just really worried about the negative impacts of tariffs, and they're really expecting tariffs to yield quite a bit of inflation in the year ahead. We're seeing a little bit of movement on the long run. I think consumers are waiting to see how things unfold before they really update their expectations over the long run.
And again, the UMich current conditions came in at 68.7. Consensus was 73.7. Last period was 74. What's the, again, kind of a big drop. Does that surprise you, the magnitude of the drop?
The main reason for the drop in current conditions is that buying conditions for durables really plunged this month. And the main reason for that is that over the last couple of months, a lot of consumers felt like you needed to buy durables now to avoid price increases in the future because of economic policy like tariffs. However, with tariffs on imminent, the ones on China already implemented, people are kind of getting concerned that it's already too late to avoid those high prices for durables. So that's why current conditions really took a dive this month.
Very good. Joanne Su, thank you so much. Joanne Su, she's the Surveys of Consumers Director at the University of Michigan. Let's get a reset of this market here. We can do that. Bloomberg Business Flash with John Tucker.
All right, this flash brought to you by IBKR. Will the U.S. CPI exceed 2.4% in March of 2025? Trade your prediction with IBKR Forecast Trader. The yes was recently at 60%. Buy yes or no and earn $1 if you're right. Go to ibkr.com/forecast. Right now, we've turned lower. S&P 500 down to 8 points, down 0.1%. The Dow, 50 points lower. The NASDAQ 100, 86 points lower. That is down 0.4%. Some of the real movement in the yield space. The 2-year is up almost 6 basis points, 426. The 10-year yield, that is up 6 basis points, 449 right now. After that, UMich, the 1-year inflation expectations really popping higher there. The job growth moderating in January. Annual revisions from the government also revealed less vigor in the labor market last year than previously thought. Non-farm payrolls increasing by 143,000 last month. And Amazon saying growth could be lumpy. It just can't keep up with demand for that AI stuff. Amazon shares right now, the early going, down 3.6%. Expedia Group, those shares gaining the most in more than a year, posting better than expected gross bookings. Expedia shares right now 16% higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Hi, Alex.
Hi. Happy Friday, guys. Yeah, it's been quite a week. I mean, from last Friday to this Friday, it's pretty much whiplash. Alex Steele, John Tucker, Paul Sweeney. This is Bloomberg Intelligence Radio. All right, so we got that weaker UMich, and you have an instant reaction within the market, right? You got the NASDAQ 100 also turning negative, stocks kind of dropping like a stone. Yields were already higher, but still, we're clearly in a very reactionary environment, which can make it very difficult to trade. Oh, Vincent Signorella just gave me a side eye there. He's here in studio again. Vincent Signorella, Bloomberg macro strategist. What was that for?
Well, it is in a way difficult to trade, but that's the whole point. The volatility gives you opportunity. Without that, you can't make any money. So.
Okay, so where are the opportunities? I guess the question is, where are things most dislocated?
The one thing I would keep an eye on is the 10-year yield. If we break above 4.5% and hold above 4.5%, it's a pretty significant level. If we get through there, people are calling it basically it's around the 50-day moving average. I don't like to put moving average on yields. I'm not so sure that actually applies. But psychologically, it's a big level, and if we stay above that, we're looking potentially to move towards 5%.
I think the UMich data was really interesting because, again, some of the magnitudes of the moves and the big ramp up in that 1-year expectation for inflation. That's something that this administration needs to be concerned about because inflation was arguably, to the average American, that is it. That is the story.
Absolutely. Totally.
Don't talk to me about the stock market. Don't talk to me about the value of my house. Maybe I don't own a home. But what I do see is I do see that inflation. So
and it's going to be a big thing for the Fed to challenge now as well because all we keep hearing is when's the next rate cut? When's the next rate cut? And the cash carry this morning and Goolsby yesterday. I don't know what they're looking at, but to me, if I look at what the Fed's going to do next, it's number one, stay on hold for quite a long time. And if these numbers keep coming in like this, they're going to be looking at going in the other direction.
Well, that's such a great point, because Torsten Slok of Apollo, his note pointed out today that the last Fed cut was in December, and the shortest amount of time from a cut to a hike was 7 months. So in theory, we could see a rate hike in 6-7 months.
Yeah,
theory.
I totally would agree with that. I mean, I personally think that's more likely the case than not.
Funny, we spoke to Dr. Anna Wong, Bloomberg Economics. They're sticking with their 75 basis point cut in 2025. I think that's now becoming kind of almost out of consensus.
I think the only way something like that happens is if we have a trade war in some way, shape, or form. Inflation doesn't really pick up, and maybe that trade war causes a recession and maybe even a little bit of a deep recession. But I will give kudos to Anna. She nailed it in the jobs numbers this morning. With the revision from 1 year to the next, expecting a number around the 600,000, and that's just about what we got, which was a bang-on hit. So she's allowed to get one wrong, possibly.
So Vince is on Squawk all day, so he's basically chatting with traders, he's chatting with people on the terminal, etc. What are the questions that you're getting right now? What are you guys talking about?
So it's interesting. A lot of the talk this morning is, should we be building in some risk for possible tariff talk toward China and Europe this weekend, coming from the administration? And I think there's a realistic possibility. More, believe it or not, for Europe than for China. That's one thing that's been on Trump's back burner, but he's really got a hankering to go after the Europeans. He's been really fed up with them putting fines on large tech companies. And so that could just pop out of the blue this weekend. You'd never know.
Yeah, we had Scott Bessent on Bloomberg Television earlier today. He's a Treasury Secretary. He made a couple of interesting points as it relates to that. One, he called out the amount of taxes paid by the U.S. versus other U.S. companies versus other countries from around the world, and it's just disproportionate. So he says you got to do something there. The other thing he called out was just saying basically, we didn't have a trade war with Canada and Mexico. It was a drug war. That's the reason behind the So, but that. I'm not sure. I think you're right. Then the question becomes, when does the administration turn their sights on Europe? And that becomes another.
And then also for Europe, like, what's the ask? Yeah. So if your ask for Mexico and Canada is a drug war, okay, well, what's your ask for China? What's your ask for the European Union?
Well, for China, one of the things you mentioned, Bessent, he said yesterday that China is going to be eating most of the tariffs with the United States, which, if you think about that, that means, number one, the tariffs aren't going anywhere against China like they did on a pause with Canada and Mexico. Number two, they could actually be ramped up a bit. So if the administration feels that China is going to eat those tariffs more than the U.S. consumer, it's more likely than not that they would feel more comfortable raising tariffs against China. And for Europe, what is the ask? That's a really good question. Maybe just leave us alone and stop taxing our companies. Or is it defense spending?
Is it just that?
I would imagine it would be part of it, although they are ramping up some defense spending. They actually said they were thinking about putting troops in Greenland just in case Trump showed up this morning.
Exactly. All right, so looking at the dollar, the Bloomberg Dollar Index higher yet again here. Again, my kind of standard currency FX question is there any bear case for the dollar, short term or long term?
Not so much short term. I think long term, you get a situation where if you do get tariffs, if you do get inflation, you're going to see real yields come down. When real yields come down by comparison to other countries and other currencies, you do get the case that there's a potential for a sell-off in the dollar, or at least a pairing of gains for the dollar, maybe trading sideways to a bit lower, not really seeing it fall off.
There was a really interesting piece, though, that talked about how hedging all this stuff and headline risk in the FX market was getting really hard, and that things were getting really expensive to hedge and take advantage of this volatility. What are you noticing?
Well, first of all, it's always hard, having done this for like 30 years.
That's a pretty good answer.
The second part is when you see vol go up, you see options get more expensive, and that's probably what they're talking about in the expensive part. If you're hedging it with options and vol goes up, it costs you more money.
What are you looking at here? What are the next data points for you? We'll digest all this economic data that we got today, sleep over it over the weekend, but what's the next big thing for the market, do you think?
I think after you see the UMISH numbers, you really need to look up, see where CPI and PPI go next. That's the stamp, and then you're going to see the employment cost index at some point as well. If all of those are on to the upside, I think you really have to throw out the next rate cut coming anytime soon, really.
So do you think that we're still in a U.S. exceptionalism world, or no?
For some reason, I mean, it looks that way in terms of the job market, which is really holding up. But I think what totally gets forgotten in the conversation is jobs are a lagging indicator. So you should expect jobs to hold up for some time well into a turn in the economic growth. And I think that's maybe the cycle we're in now, that we are facing the potential for some slower growth. It's happening in China, it's happening in Europe, it's happening in the UK. It's incredibly difficult to believe the United States is going to just go it alone.
What's the risk appetite out there when you talk to folks these days? Is it a little bit taking it off the table because I just don't know what's going to happen out of Washington? Or do I say, I got to be out there taking risks because the rest of the world is not much?
So the interesting thing is, you know, Main Street is all in taking risk, while Wall Street is backing away from
retail traders. There have been a lot of pieces about retail traders, mom and pop guys buying the dips.
You know what? Retail traders get it wrong over 85% of the time in the FX market. So I don't know what that's going to mean for the equity market. But if that follows suit, you know, the wheels are looking like they're going to fall off pretty soon.
Do we feel like the U.S. exceptionalism trade in the markets is still a thing?
It's still a thing for now, but I mean, how long that lasts, I don't think it's going to go on. And either the other countries will catch up and start to grow, or we're just going to have to slow down. It's just really hard to believe that we can just go it alone.
I wonder, just broadly defined for this global economy, what is an impact of, you know, the decline in globalism, at the same time China, you know, slowing down? The question how materially they're slowing down, how structurally challenged they may be. Can the rest of the world work if China's not working?
That's a really good question. It's hard to believe because China's become so involved in the economies of the rest of the world. And it just, me personally, believe that they're growing a lot slower than they are letting us know. They're suggesting they're at 5% growth right now. But when you look about the amount of monetary stimulus they put into the economy, the amount of fiscal stimulus they put into the economy, and it's done absolutely nothing, it suggests that those numbers are going to go down.
I mean, yeah.
I agree. That's where, and I think 3, 4, 5 years ago, that would have been a bigger headache for the global economy than today. So anyway, Vince Signorello, thank you so much. Thank you. Appreciate that, getting the latest here. Let's head down to New Orleans, Louisiana. They got a little football game coming up down there. And our very own Vanessa Perdomo is down there for Bloomberg, and she's sitting down with one Emmitt Smith, former Dallas Cowboys Hall of Fame running back.
Thanks, guys. Yep, I'm here with Emmett. Oh my God, I just blasted your ears there. I'm sorry. Yeah, we're here in New Orleans. It's Friday, 2 days from the Super Bowl. How are you feeling?
I'm feeling pretty good. I don't have to play on Sunday, so I'm good.
So now that you come here as a former player, is it how different is it from when you used to come to the Super Bowl? When you used to win?
When I was playing, we didn't come in here. We had everything done at the stadium or at our practice facility, wherever we were at. And so all the media training, all the media conversations, all that took place at a totally different place. And so, but as the game evolved and you don't come to the Super Bowl, now you get a chance to walk down Media Row and deal with all those different conversations and everything else. It's completely different. I kind of like this side of it. Because
better than winning Super Bowls?
Not better than winning, but I kind of like this side. Since I'm not playing any longer, I kind of like this side because I get a chance to see former players and get a chance to be involved in a different part of the Super Bowl.
Yeah.
The behind the scenes kind of Super Bowl.
Yeah, absolutely. I was going to say, you know, setting the scene for people here, it seems like walking around, you know, you get to see guys that you probably see here every single year, like a fraternity almost.
It is like a fraternity to some degree, but you have new players walking the floor, like Jaden Daniels and other players, that new guys that you see on television don't know who they are, but you get a chance to meet them up close and personal and see their response when they see you. And do they really remember you? Because it's been like 20-some odd years, 30-some years since I played, but having that kind of interaction with these young men and just seeing the different side of the game is kind of cool.
And is this kind of the first place you get to see some of those young players here in Super Bowl week?
Pretty much, because I don't go to many games. I watch them on the television too as well, but the games that I do go to, I don't necessarily walk over to the visiting team side, but I may see them on the field before the game or something like that, doing pregame and all. But here, if you're not in it, you're walking the floor. And if you're walking the floor, I'm going to see you at somebody's party. If I see you at somebody's party, then great, we interact, we talk, PA parties and stuff like that. So there's a lot of activities that goes on around the Super Bowl itself that if you're in the game, you don't get a chance to experience, but outside the game, you get a chance to experience a lot.
It's its own life.
It is.
The week of the Super Bowl for
Yes.
you. Is it something like you block this off every year? You
Yes.
have to come back every year.
Yes.
How many years have you been coming now?
I've been coming back probably since I retired in 05, and every year is something different because I do represent various different types of products, whether it's tequila, whether it's Narcan and nasal spray that I'm here with now, or if it could be Tableau or something like that. But for the most part, I am walking for bringing gifts, having conversations with people like yourself and others, interacting and talking about the game from a different perspective. People want to talk about my Dallas Cowboys all the time because of the things that we're going through. So
A lot of things.
It's a lot of different conversations.
Yeah, absolutely. So let's talk about Narcan. You're here with them today. You have a personal connection to it.
Yeah, my personal connection with this is, first and foremost, I lost a teammate in the late 90s to an overdose. And he was a very great friend and teammate, and he was a great offensive lineman, and miss him to this day because of just something as simple as an overdose. And I call it simple, but it's a problem. And it has grown to become a much larger problem today because of fentanyl and other things as well. And it doesn't just necessarily affect athletes, it affects everyone on the planet because you don't know when and where you may need help or when you might be in a position to help someone else. And so with Narcan nasal spray, we have a saying, if you stay ready, you don't have to get ready. And that's why we call it Ready to Rescue campaign. But here in New Orleans specifically, when you start thinking about the overdose or the opioid overdose at the highest level, when you start thinking about the national average has come down. But here in New Orleans, the average is higher than the national average, and it's steady rising. So New Orleans, I'm here to try to help you help someone else that might be in need.
Yeah, absolutely. So it is really personal to here and everything like that.
And personally to me, not only did I lose a teammate, but I had a sister-in-law that was dealing with cancer and had to go through chemo and was on certain kind of medication. She got into a situation where she was dependent upon the medication and ended up having a couple of opioid overdoses episodes. And so going through that with her and watching my family having to deal with those kind of things, it was different.
Yeah. It's interesting, too, the Media Row aspect of it, that you get to come here, talk to a bunch of people about products that you care about. And for this one particularly, and a lot of your other partnerships, they're not just you here this week talking about it. You're partners with them for a long time.
I have been partners with them for a long time. With Narcan and I, we go to college football games. We do the same kind of outreach program at college football games. We've done it a number of different times this past year, about 3 or 4 times. And if my schedule would open up a lot more, because I got a son that's playing college ball, so I like to be at his games a lot more. And so, but for the most part, we're sending a message. It's not just for the Super Bowl, it's throughout the course of the year.
Yeah, absolutely. And last year's Super Bowl was in Las Vegas, and you recently opened a restaurant there. Tell me about that.
Yeah, I opened up a restaurant called Emmett's Las Vegas. It's right there on the strip, across the street from the Wynn Hotel, in front of Fashion Show Mall, right there on the strip between Palazzo, Wynn, Fashion Show, and Treasure Island. We're right underneath the Capitol Grill and Benihana's right there on that side. And so if you're in Vegas, or if you're traveling around and you find yourself in Vegas or somewhere close to the area, please stop through Emmett's Las Vegas, have a drink, order something to eat. We have great tomahawks, great sushi. We also have tremendous butter cake. We also have great sides, whether it's mac and cheeses and all kinds of stuff too. So we're there to feed you.
Yeah. Well, why am I hungry right now at 9 in the morning, for this tomahawk steak? Yum.
I don't know.
Great.
The tomahawk is pretty good.
Yeah. So, when you're deciding on your next business venture, what are the things that you go through in your head when you're deciding?
One, is it a niche opportunity, or is it something that could be transformative, or can I truly make a difference in this particular area that may be lacking someone that brings something different to the mix? And so, and then after that, it's about the financials. What are the demographics that we're going to serve? And then the financials of the demographics. And do we have a product that caters to the lifestyle of that demographics? And then who's the competitors?
Yeah.
How much of this market share can we gain? Can we gain any at all? Is there enough market share growing in this area that makes sense for us to be here? And If we had to advertise, what are the advertising? Let's put the financial budgets together and everything else. Now let's talk about employees. How many employees would we need? And what's the cost and everything else? So it's a lot of different things that goes in the mix before I actually jump in.
Yeah, it's definitely on. You're invested in real estate and construction.
Right.
What is your favorite sector?
You know what? When you think about real estate and construction, they're kind of one and the same. You can buy land and never build anything on it. That's okay. But if you buy land with the intent on developing something, you're going to have somebody from a construction company come in and do it. So at the end of the day, they kind of work hand in hand. And when you add in solar energy to the mix, all those things, new modules, new lighting, new this, new that, even solar panels on the roof, and backup battery generators and everything else, all those things kind of play together in the context of real estate and real estate development.
It's really smart. You got it on both sides.
Well, vertically integrated. Let's call it that.
Yeah, absolutely. So I got to ask about the Dallas Cowboys. Can't let you go without asking about the Dallas Cowboys. So what do you think about the head coach? Do you think it's a move to get them here anytime soon, the Super Bowl?
You know, I'm not sure. I have to see how this coaching change stabilizes the offensive coaching, whether or not he's going to upgrade on the defensive side of it, or he's going to keep things the same. What does it look like? What does the coaching staff look like? And what are these different coaches bringing to the table to help enhance the Dallas Cowboys offense and make the Cowboys defense better? What kind of offensive system are we going to run? And are we going to run the same defensive system? And then next, do we have the personnel to do it? Or do we have to upgrade the personnel? And how long is that going to take? And what type of financial constraints are we under with salary cap issues? So there's a lot of different dynamics that goes into this before I'm able to actually judge whether or not we have the right coach.
All right, well, we'll see. Emmett, thanks so much for joining us here at Bloomberg. Back to you guys in New York.
All right, that was Emmitt Smith, former Dallas Cowboy Hall of Fame running back, speaking with Bloomberg's Vanessa Perdomo. They are live down there at Super Bowl Radio Row.
Now, you're flying Sunday. Are you watching and flying? What are you doing?
Well, assuming the weather doesn't ground me, I should be out in the Rocky Mountains in time to watch the game.
Ah, okay. So he's going to do both of those great things. All right. In the markets, you are seeing yields move higher. Also, equities struggling here after that jobs report. Yesterday, Treasury Secretary Scott Bessent sat down with the Bloomberg News Saleha Motion for an in-depth interview on his first weeks as a Treasury Secretary. When asked about his first meeting with Federal Reserve Chair Jay Powell, Bessent said he had a constructive first meeting and he trusts Powell to make the right decision.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive. Everything I'm going to talk about is things Fed done in the past. Prospectively, monetary policy I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
And speaking of monetary policy, we got those jobs numbers today and the immediate reaction in the market, in particular that UMich sentiment, which is the weakest in 7 months. Inflation expectations moving 100 basis points higher for the next year. Joining us now, Lindsay Piesga is chief economist over at Stifel. Can we just talk about the UMich numbers for a second and the reaction within the market and that big jump in inflation expectations? What do you make of that?
Well, I think it is a concern for the market, recognizing that inflation is likely to prove much stickier in nature than the Fed had previously anticipated. And this not only calls into question the Fed's earlier decision to stop short of what we've long argued should have been a much higher terminal level, but it also calls into question now the Fed's ability for further downside relief. And so you see the market responding to that with yields pushing higher this morning after this morning's jobs report and the confidence report.
So, Lindsay, what did you take away from the jobs report this morning?
Well, it was somewhat disappointing on the headline, no doubt, falling to a 3-month low in terms of that monthly job creation number. But what we see is a lot of that was likely weather-related weakness. And when we look at the other components, that strong upward momentum, a stronger than expected monthly jump in average hourly earnings, the unemployment rate ticking down to an impressive 4%. Again, this continues to set the stage or set the tone of tight-ish labor market conditions. supporting the Fed's assessment, as we saw in that January FOMC statement, that committee members are moving away from concerns of emerging weakness on the labor market side and conceding now that labor market conditions are likely to remain not only stable, but solid going forward into 2025.
The risk, though, has to be the tariff question. I forgot to turn on my mic. I love that I do that on a Friday. And you saw that in UMich. Like, both groups from both sides of the aisle are worried about inflation expectations related to tariffs, particularly when it comes to, say, durable goods and buying them now rather than later. We also saw wages tick up in the jobs number. All of that is an inflationary spiral, no?
Well, it can be. It depends. Tariffs in and of themselves are not inflationary if we're talking about a one-time price increase, but they absolutely can be inflationary if they result in this tit-for-tat retaliatory cycle that we saw during Trump's first term, back and forth with China. So again, it's going to depend on the scope and the intensity of these programs, but also from an immigration standpoint, policies that further restrict the labor supply in this country could exacerbate the already present divide between labor demand and labor supply, and, as you mentioned, continue to put upward pressure on wages. At the same time, the administration has talked about reining in the size of government, reducing outlays, finding areas of waste and inefficiencies, which could more than offset some of those inflationary pressures in the marketplace. So it remains a big question mark, but it does appear that investors, looking at market's reaction, it does appear that investors are concerned about the upside risks to inflation at this point.
So putting all that together, Lindsay, what's your view of the consumer right here?
Well, I think the consumer is still very solid. The consumer continues to prove very resilient in the face of a difficult environment. Years of elevated prices, elevated borrowing costs, the resumption now of student debt payments. That being said, there are a lot of challenges facing consumers, potentially further higher prices or further increases in borrowing costs at this point. But we also have to look at the fact that consumers are incredibly savvy. And with real growth in income, gaining momentum, as well as access to other supplemental factors like 401ks, hardship withdrawals, credit cards, it's clear that consumers still have a good amount of spending and borrowing power left. But again, those challenges are very real as we look further into the new year.
All right, Lindsay, thank you so much. Really appreciate it. Lindsay Piesga joining us, chief economist over at Stifel. We're going to take this perspective and now put it into what it means for banks, particularly regional banks. We're going to talk to the CFO, Zach Wasserman at Huntington National Bank. They just had an investor day yesterday, and the read-through was pretty positive. They're expanding, they're growing, they're looking at digital offerings as well, and they have a really good read on small businesses and loans, and they consistently see solid net interest income. They consistently see solid loan growth. We're going to break that down with the CFO. Taking a look at the markets, weakness across the board, but the bond market really moving. You got 10-year yield up by 6 basis points, 2-year up by 6. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. And the major stock averages lower right now. I'm going to pin this on yields. Yields are higher after the jobs number and the University of Michigan inflation expectations numbers. Looks like a lot of people worried about rising prices because of tariffs. The economy adding 143,000 jobs in January after an upwardly revised gain of 307,000 for the month of December. The revisions for the past 2 months, the previous 2 months, totaled 100K, and the unemployment rate slipping to 4%, matching the lowest since May of 2024, so maybe no need for rate cuts. Amazon warning investors it could face capacity constraints in its cloud computing division. We got those results after the close yesterday. Amazon shares right now down 3.5%. Somebody's not investing in their face.
I know.
Elf Beauty. Sounds like a cosmetics firm for hobbits. The cosmetics company lowering fiscal year projections for sales and profits, citing softer than anticipated January trends. Elf taking it on the chin, 20%, 19.3% lower right now.
Yeah.
Overall, the S&P 500 down 13 points, Dow down 79, the NASDAQ 100 87 points lower, and the 2-year yield 7 basis points higher. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash.
So 2 thoughts on that. One, L'Oreal, Estee Lauder also having issues, so that really disrupts my invest in my face thesis. And also, if it's Elf Beauty, why hobbits? Why not elves?
Okay, but I thought maybe that would be controversial.
Okay, yeah. I mean, elves do have really good skin. Okay.
Do they?
I'm a big Lord of the Rings fan, all right? I'm a big Lord of the Rings nerd. There you go. There you have it. All right, one stock we're watching today is Huntington Bank shares. Over the last 2 days, they're up by about 1%. They had an investor day yesterday where they laid out their strategy for the next few years and where their growth opportunities are, and the market took it really well. Zach Wasserman is Chief Financial Officer at Huntington National Bank, and he joins us here in the studio. Thank you so much for joining us. We appreciate this.
It's a pleasure to be with you.
So I think Huntington, and I think a company that lends a lot to average people and small businesses and sort of knows the economic roots, but you guys are also trying to expand that and become something different. Can you walk me through that?
Sure. Yeah. The business has been performing exceptionally well recently, and one of the reasons is because we're driving expansion, both geographically and in our commercial business, expanding in a number of specialty vertical areas and national business lines. Just this year, we've launched into 3 new states, North Carolina, South Carolina, and Texas. And we've also established 8 new specialty verticals that are national. For example, a funds finance vertical that's supporting private equity clients, one that's focused on the mortgage ecosystem and other national, commercial areas.
Talk to us about loan growth. What I do know about the banking business, that's an important driver. So talk to us about loan growth, where it's coming from, where you're seeing it, and is it kind of in line with what you were expecting?
We've actually had very strong loan growth over the last 2 years. If you take a step back, much of the industry has been in a pretty neutral position, not actually growing. Huntington has outperformed that by about 10 percentage points. And for us, the growth is coming from both our core business, which is consumer, small business, and then mid-corporate, typically private commercial clients. And then also these new initiatives that I just mentioned before, launching into 3 new states, a number of specialty businesses. So we're seeing a nice breadth of growth, actually. One thing that's actually, a nice indication of the economic strength is we're seeing strong demand from small businesses, from our regional banking business, typically in the kind of smaller middle market client set. So it's been a healthy dynamic we've been seeing.
Before you were in this position, you also was Chief Financial Officer to Visa, and I know that Huntington is trying to get into the payments business in a particular way too. What's what's the market for that, and how do you guys play and compete in that?
You know, the market for payments is incredibly broad, and if you take a step back,
how do you categorize it actually?
Yeah,
like, is that Zelle, or like, what is that?
You know, it is so broad. The one that really needs to zoom into it. You know, we have a number of card-based payment products. So think consumer cards, commercial cards, but also importantly treasury management, and that's really the biggest driver right now. What we're seeing in payments growth, supporting commercial clients with the ability to accept payments and then make payments in essentially every form you can imagine, Alex. So big growth driver there. One of the things that we've done recently is invest to expand our merchant acquisition capability. Merchant acquiring is when a company accepts payments electronically, and it's often the linchpin of their business. Just the lifeblood of the company is how they accept payments. So we launched a merchant acquiring business just in October, and it's been going incredibly well. So, you know, kind of almost every area there's growth in payments for sure, but for us, treasury management and commercial payments in particular is a major growth driver.
Talk to us about your loan portfolio, specifically your exposure to office real estate.
You know, office and commercial real estate generally for Huntington is a very small exposure, actually. Typically for large regional banks, the average commercial real estate within the loan portfolio might be 15 or 20% of the loan book. Okay. For us, it's 9%. Okay. So we're relatively smaller, and an office is only 1% of that 9, to give you a sense. With that being said, you know, what we're seeing in that commercial real estate environment is this is gonna be a situation that plays out over multiple years. Thankfully, we are seeing a fairly orderly process of refinancing and generally seeing pretty sound ability for our commercial real estate developers to maintain their financing and to successfully roll through maturities. But it'll take a while to run through. To give you a sense, something like 20% of the portfolio matures any given year. So this will be, you know, on average, it'll take 5 years to really roll through. So I think that's a kind of an industry dynamic we're seeing, this is a dynamic that will play out over quite some time.
What part of this encompasses any kind of M&A? Versus organic, I guess.
You know, for us, we're focused on organic growth. M&A it can be a tool for banks to grow. Certainly, we've seen M&A in the industry over time. With that being said, it can also be distracting to the progress that the company is making on organic growth. And for us, Alex, we're seeing so much progress on our organic growth initiatives, both acquiring customers, but also, importantly, putting more and more focus around the value-added fee services that come to them, namely payments, wealth management, and capital markets. And so, you know, just the customer acquisition we're seeing, the success in those businesses, that's where our focus is. To give you a sense, in the fourth quarter, we just closed, a 10% year-over-year revenue growth, really driven by those organic strategies.
Okay. What's a typical corporate customer for you guys?
You know, often, Paul, they are middle market companies that are private. That's the most typical company. The regional banks serve a really important niche within the overall U.S. economy because the client set that we are servicing are typically focused on their local market. They want to bank with a company that is deeply embedded in the community and knows them personally, but importantly can bring down to them the power of a large bank in terms of specialized capabilities. It's actually one of the reasons why we've been so successful in these new geographic launches.
Well, how about private credit? Is that a competitor to you?
You know, it's funny, we get this question all the time, and the answer generally is no. Okay. Private credit is looking for the kind of loans that they finance are typically where there's more leverage, where there's more yield to be had because of the risk. That's not the core client for Huntington, and so we were up on stage at our Investor Day yesterday, and our head of commercial business mentioned that only in 2 cases last year across our entire business did we see commercial borrowers actually go to a private credit facility away from our own lending facility.
All right, Zach, thank you so much. We appreciate that. Zach Wasserman, Chief Financial Officer of Huntington National Bank, located in Columbus, Ohio. Matt Miller, Columbus, Ohio as well.
So he still banks there even though he lives here?
Well, he's a player. Well, I think this is old. This is the Miller account. You don't let the Miller
this is
account
different.
go.
Gotcha.
Anyway, 20,000 employees there. It's got a market cap of just about $25 billion. The stock's up about 4.5% year to date. trailing 12 months up about 38%, so performing well. But, I'm looking at, kind of the comps there, which we have on the BQ function. Bloomberg thinks of everything. The comps are all up over the last 12 months, 30, 40%. So the regional banks have been making a nice comeback off of that scare several years ago from some of those banks. So it's good to see that coming back. S&P 500 off 15, Dow off 126, NASDAQ off 100. We'll have more coming up. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Let's go to some of the stocks on the move that's kind of disassociated a little bit from the macro, and that comes in the form of Amazon. That stock is down by about 3.6%. Anurag Rana, Bloomberg Intelligence technology analyst, joins us now. Anurag, what was so upsetting in yesterday's call that has the stock down 3%, or is it not a big deal and Alex just stopped talking?
No. There was a lot to I'd say package in the earnings yesterday, and the biggest one would be that AWS, which has seen a massive spike in profit last year, there's a very high likelihood that's going to reverse this year in terms of the margins, just because the company's going to spend over $100 billion in capex in 2025, and a large portion of that is going to go for the AI buildup, and I think that's really the big theme this year, that we're going to see a lot of data center build up, a lot of prep work for AI workloads to come in, and that's partially the reason you see the stock down a little.
Of course, we're a whopping 5% off of the all-time high. So This is quarter, I guess one of my takeaways, Anurag, from the tech quarter so far with some of these internet names and AI names is that if you're Meta, if you're Google, if you're whomever, Amazon, cranking up your CapEx. And I'm not sure that's a good thing. How does a market think about these, step function moves higher in capital spending?
I think the biggest question is going to be whether this kind of business, AI business, requires continuous investment in CapEx, or similar to cloud, that you're going to build once and then you're going to get a high recurring revenue after that. I think it's going to be the latter, but the big question is going to be, do we see a bigger CapEx growth in 26 and 27 and so forth? Microsoft, whose financial year ends like in the middle of the calendar year, has talked about the growth rate of next year to start tapering down. So that's the first sign we know that the growth rates are coming down. The absolute number is going to be a little bit higher for FY26 for Microsoft, but that's at least shows there is some level of peak or near peak we're going to reach over the next couple of years.
But on the flip side, if we saw Amazon pare back their spending, wouldn't the argument would be, oh, well, their stock is down because they're not spending as much and they're going to fall behind?
I think that's absolutely why all of these are doing, because Microsoft went ahead and said, we're going to do 80 billion in AI spending. Then Meta came back and said, well, we're going to do 60, 65 billion. And then we heard the Stargate announcement. And then after that, Google came and said, we're going to do 75. These guys are saying we're going to do 100. So, and also remember, by the way, if you don't see the demand coming in the next 6 months, all of this can reverse also. It's pretty quickly, because not all of that is fixed cost. There are some, variable leases in there. There is some demand-related stuff. So, it's possible if the demand doesn't come through, there could be a reversal in this theme.
Where's the Apple story right now, Anurag? Stock's not performing.
Yeah, I think the most, honestly, yesterday's news that Mark Gurman break on the iPhone SE is probably something that they can help them out in emerging markets, especially China, India, and Brazil. This is the first time upgrade of a new phone that's going to be, let's say, for the sake of discussion today, we don't know the price. The starting price of the old one was $429. Let's say this is somewhere around $500. It will have Apple Intelligence. It will have a faster processor. And if this thing takes off, I think this can bridge the gap that they are facing in those countries right now and maybe give them a push. There's a lot